Hello warriors, I hope you're all doing great. Rahul Bhaiya is here to discuss something extremely nice and important with all my CA Inter students appearing for the May 26, September 26 and Jan 2027 examinations. Over the past few weeks, I have been taking a little bit of an additional time from my side to prepare something really exciting. Today, we're going to be discussing about the Super 50 adjustments. Super 50 adjustments is basically a document where I've tried to compile all the toughest adjustments which has come in examinations, not for one thing that it is tough, but probably also because these are adjustments which you generally tend to miss or generally tend to make an error in examinations, because of which heavy marks are lost in examinations. So this adjustment sheet is going to super help you to make sure that you don't make these errors and have an edge over every other student who has probably not watched this video. So yes, I would like you all to take a time out and do these adjustments with me carefully so that you get the edge over in examinations. So I am not going to waste any further time. I'm going to dive into this topic. We're going to do some very beautiful adjustments in this whole document, multiple chapters, multiple layers, proper analysis of each and everything. And I'm going to be writing it along with you so that you have a better understanding on things. Yes, so let's start this chapter. Let's do 50 adjustments from our side and have the grip over your direct tax to make sure that you get the amazing amount of marks in this coming examinations. Shall we start? Chalo. No, let's not do that. I think this is not getting exciting, people. I know I'm going to put efforts and I'm going to write all the answers myself. But why should I be doing the one alone? Yes, so I'm not going to do it. Let's do one thing. Each and every one of you are going to pause this video and are going to take the document from your comment section. From the comment section and descriptive box, you will get the PDF of this document. I want you to go, sit, prepare the answers once yourself first, and then look at this video to review the answers. At the end of the day, people, the flavor and the fun is only when you can do it on your own. Yes, so please go back, do these answers once, and then come and look at this video. Try to tally both the answers together, and let's see how much marks you score. So your job is going to be fairly simple. Download the document from the description box, make the answers, review the video along with me, and then give me a comment in the comment box saying, "Hi Rahul Bhaiya, I am attempting this attempt and this is the mark that I've got." I really want that one from your side, people, so that I can also feel happy which set of students are reaching out to me and what kind of excitement that you're showing towards the subject of direct tax. Yes, so every single one is going to drop a comment section to me and going to tell me that Rahul Bhaiya, after the Super 50 adjustments, I've got this mark, but I've really learned so much better in this video and I'm going to make sure that I do not make these mistakes in my examination. One commitment I'm expecting from your side, people. I hope you can do this much for your Rahul Bhaiya. Yes, chalo. I am going to start this session. You are going to pause the session and complete the answer and then come back and watch this video. Chale, people, deal. I'm going to start the session, people, by looking into rates of taxes. The first question, the very easiest question, the question comes and says, what are the slab rates of a non-resident aged 76 years under the DTR and the ATR scheme? The first and the most important thing to realize is that when you see the word non-resident, there are certain benefits that are denied to you. Benefit number one that is denied to you is that as a non-resident, you do not get the opportunity to go to the higher exemption limit of 3 lakh and 5 lakh under DTR schemes. So as a person being non-resident, the age of 76 years are no more relevant to me. I don't care. That is the understanding with me, and therefore with that understanding, I think the answer can become fairly simple and straightforward. I hope you know this also, people. What are the schemes? If I'm going to ATR scheme, the answer is going to be that for the first 2.5 lakh rupees, I'm going to be taxing nothing. From 2.5 lakh rupees to 5 lakh rupees, I'm going to be taxing at the rate of 5%. From 5 lakh rupees to 10 lakh rupees, I'm going to be taxing at the rate of 20%. And then after 10 lakh rupees, I'm going to be taxing at the rate of 30%. Correct, not correct? Notice carefully. Despite the fact that my age is 76 years, I don't care. I'm not giving you this benefit no matter what. But if I'm going under DTR scheme, I think honestly, I don't care. Because under DTR scheme, you don't have any age limits. You don't have any residential status restriction. Nothing matters for you. So the answer is going to be fairly simple. I'm going to simply come and say that for the 0 to 4 lakh rupees, you're going to tax at 0%. From 4 lakh rupees to 8 lakh rupees, I'm going to tax at 5%. From 8 lakh rupees to 12 lakh rupees, I'm going to tax at 10%. From 12 lakh rupees to 16 lakh rupees, I'm going to tax at 15%. From 16 lakh rupees to 20 lakh rupees, I'm going to tax at 20%. From 20 lakh rupees to 24 lakh rupees, I'm going to tax at 25%. And then after 24 lakhs, I'm going to start taxing at 30%. No changes whatsoever when it comes to non-resident in DTR. DTR rules are always going to remain the same because there is no age restriction. But yes, under ATR scheme, you have a problem, and non-resident, despite being more than 60 years, are not going to get the higher exemption limits. They are still going to be at the normal slab rules. And that's what the understanding for you is. Clear? Chalo. With that, people, I'm moving on to your second question. A fun question, people. You should get this right answer. So look at this very carefully. Question comes and says, they want you to know the surcharge rate if the total income of Lala under ATR scheme is as follows. They have given you the income statement. Income statement says, my PGBP income is 75 lakhs. My 112A is 1 crore 56 lakh. My 112 is 1 crore. And my 111A is 55 lakhs. With this, they are asking you a very simple question. Tell me what should be the surcharge rates. Now, if you have done the classes properly, I have told it in my class also, people, that there is a master format which I follow. The master format requires step number 1 to total the incomes, because that's where the answer changes first. So I'm going to total the income, and if my memory serves right, the fair understanding of this total income should be around 4 crores and odd. Yes, so if I'm looking at it, 2 crore 56, 2 crore 61, 3 crore 11, 3 crore 16, and yeah, somewhere around 4 crores. So you're getting somewhere around 4 crores, people. The moment you see the total income is 4 crores, you will now jump and say, Rahul, person is rich, Mr. Lala is rich, and therefore should apply a 25% surcharge. But the moment you said a 25% surcharge, 4 incomes suddenly got a heart attack. 4 incomes suddenly showed a heart attack and said, yo, 25 and all, I cannot accept itself. Chance hi nahi hai, no acceptance at all. I will only take maximum 15. These 4 culprits are 112A, 112, 111A and dividend income. These 4 incomes come and say, I will not accept the 25, I am going for 15%, and out of the 4 culprits, 3 are sitting here. With the 3 culprits sitting here, I have no other choice but to move these persons to 15% regime. I have to only give them a surcharge of 15%. I cannot give them anything more than this. Correct? Yes. But with these 3 persons showing the betrayal, PGBP will now come and say, they are not part of my family. I am going to keep myself separate, and I'm going to look at myself separately. Now, if you're going to look at PGBP separately, people, the PGBP showing a 75 lakh rupees. And this is where the mistake comes. In examination, the hurry which you have, the first thing you will say, Rahul, if I'm looking at PGBP standalone basis, the person is sitting somewhere between 50 lakhs to 1 crore. So let's apply a 10% surcharge. Let's give him 10% surcharge. If you end up giving a 10% surcharge, I am sorry, 0 marks. 0 marks. For those who remember in the class, we have discussed this in detail as well, that I've told you. The moment your income crosses 2 crores, the minimum surcharge that you have to apply, I'm repeating myself, the moment you cross your total income of 2 crores, the minimum surcharge that you have to apply on every income has to be 15%. You cannot give a number less than 15%. You have to give a 15% surcharge. Even if I am at a number less than 50 lakhs, I don't care. Because the moment you cross 2 crores, you were rich, and a rich person only had a problem with 25 and 37. He never had an objection to 15%. Income tax will not let you drip down to 10% and all. Income tax will minimum expect a 15% surcharge. Yes or no? Yes, so be very, very careful on this. This is a tricky adjustment, so be smart about it. Clear? Chalo. Next one, people, is an amendment of the current year, and therefore I've put it off very importantly for you. The amendment of current year on the question on what is the rebate rules when it comes to DTR scheme and ATR scheme. What are the rebates not eligible on? And this is where students have been making horrible mistakes in examination. People, under ATR, you cannot claim rebate only on 112A incomes. That's all. That's all. That is the only rule. Meaning every other income under ATR is eligible for rebate, including winnings and unexplained income. Even winnings and unexplained income can claim rebate under ATR scheme. That's the concept. But if you're going to DTR, you cannot claim rebate on any special incomes, and that's the amendment of current year. Yes, so be very, very careful about it. Income tax now comes and says that under ATR scheme, you cannot claim rebate on 112A, but under DTR scheme, you cannot claim rebate on any special incomes. That is to be kept in mind. Please notice this one thing carefully, because this is one mistake students are making in examination. Students have been having this impression that winnings and all cannot be claiming rebates. No, you can claim rebates. Be very careful about this. I'm going to write it for your understanding. Winnings is eligible. Let me put this out very clearly. Yes, so be very smart enough to understand that when it comes to 112A, 112A is eligible is not eligible for rebate under both the regimes, but winnings is eligible under old tax regime. You have to give that person the benefit of it. Clear? Yes. Very good. With that understanding, people, let's move on forward. I am looking at question number 4, a fun question from my side. Question says they want you to compute tax if the total income under ATR scheme is 5 lakh 10 and under DTR scheme is 12 lakh 50. That is what the question requirement is. Yes. So the question requirement is that under ATR I am at 5 lakh 10,000 rupees. With my income at 5 lakh 10,000 rupees, how do I calculate my tax? First things, people, let's calculate tax. A very simple compensation. I'm going to say that under ATR rules, my tax is going to be what? Let's calculate tax. For the first 5 lakh rupees, you and I know tax is going to be 12,500 rupees. Yes. So I'm going to take my tax as 12,500. The left off, remember, is 10,000 rupees. That 10,000 rupees is going to be taxable at the rate of 20%. Yes. So by that understanding, I'm going to say 10,000 rupees ka 20% is 2,000. Another 12,500. Answer is going to show 14,500 rupees. Correct? Yes, this is the conversation. Now look very carefully. With my tax being 14,500, how much extra income did I earn? People, my income was 5 lakh 10, which means had my income been 5 lakh rupees, you would have said tax liability 0. Correct, not correct? Yes, my income tax would have literally been 0 if my income would have been 5 lakh rupees. By earning an extra 10,000 rupees, you have now asked a tax of 14,500. Am I being fair here? No, I am not being fair. I know I'm not being fair, but there is one problem. The problem is very simple. To claim a concept of marginal rebate, you have to be under DTR scheme. ATR scheme does not have the concept of marginal rebate itself, which means this number is taxable as it is. You cannot avoid this number. You have to pay tax on this, and therefore you are going to lose money here. You are going to pay unnecessary taxes, but you have to do it no matter what, which means with the number of 14,500, if I calculate tax on this, what is my tax coming in? I'm going to show 14,500. Sorry, 14,500 into 4 divided by 100. Answer is 580 rupees. So which means 580 is getting added to my statement. With 580 getting added to my statement, the answer is going to be 15,080. This is how the conversation is going to look like. Clear? Yes, that is what the rules are. But when it comes to DTR, things are going to change a little bit. Look very carefully. In DTR, people, my income is 12 lakh 50. With my income being 12 lakh 50, based on the limits which I've given above itself, notice what is happening. Up to 12 lakhs, I would have paid tax of, let's say, 20,000, 60,000 rupees. Yes. So what would have happened here? I would have said zero tax here. I would have said 20,000 rupees here. I would have said 40,000 rupees here, which means 60,000 rupees is guaranteed up to 12 lakh rupees. Apart from that, I earned an extra 50,000 rupees. And that 50,000 rupees is going to be taxed at the rate of 15%. So let's calculate it accordingly. What am I going to say? My tax is going to be 50,000 rupees into 15%, which is 7,500. On this 7,500, I'm going to add a 60,000 rupees ka tax, which is 67,500. So my tax under DTR scheme is going to be 67,500 rupees. Is going to be 67,500 rupees. I hope you get this, people. This is a basic simple computation, but the problem starts here. Look very carefully. I have now come and told that my income increases 50,000 rupees. Meaning, if my income would have been 12 lakh rupees, my tax would have been 0 because of the benefit of rebate. But with the person being at 12 lakh 50, I have now been asked to pay 67,500 rupees ka tax. I am not going to accept this. What will I tell income tax department? I will tell, sir, if 50,000 is the one causing problem, you keep the 50,000 with yourself. I am not going to pay anything extra. Agreed, not agreed? Yes. So you have gone and told department that, sir, 50,000 rupees I will surrender, but 17,500 and all I am not paying to you, which means I need a relief of 17,500. And that is what we discussed in class as what we call as marginal rebate. Yes, so I'm going to be not giving you tax on marginal rebate, which means you are now going to get an exemption of 17,500 rupees, making your tax liability as 50,000 rupees. Making your tax liability as 50,000 rupees. That's the tax payable. Agreed, not agreed? Yes, with that is how the conversation will look like. Any doubts on this part, people? Notice, same thing I'm doing on the left side. On the left side also, I had to pay tax on 10,000 rupees ke liye 14,500. But did I get the benefit? No. Because marginal rebate as a concept itself has only been introduced for DTR, has not been introduced for ATR, which means in the 50,000 rupees, I'm sorry, I will have to pay a cess. So cess added 50,000 rupees pe cess. 50,000 rupees into 4% is 2,000 rupees. So I am going to say tax including cess Tax including cess is going to be what? It's going to be 52,000 rupees. Tax including cess is going to be 52,000 rupees, and that's what the statement is. Correct, not correct? This is what the conversation is, which means what has happened, people? What has happened? I have literally commented, I will not get a marginal rebate. I will not get a marginal rebate, and that's how the statement will look like to you. I hope you get this statement, people. Is anyone having any kind of doubts? This is making sense to everyone. Yes or no? Yes or no? Yes, this is what the conversation is. So be very, very careful on this conversation. Clear enough? Anyone, people? Yes, good. Let's go with question number 5. Question number 5, people, is one of the most important questions because this is somehow something which students either don't read or probably never understood this properly. There is a question which basically talks about how do you utilize your basic exemption limit. Yes, because normally the understanding is basic exemption limit is used for slab incomes. But if you don't have any slab incomes, then what do you do with this? And that's one question which has been asked in exams multiple times. So notice one thing carefully. In our class, we call it Kaju Katli effect. If you have understood that, then great enough. But otherwise, the provisions are like this. The provision comes and says that if you are going to be a resident person, then the utilization rules are very simple. First, as a resident person, any incomes that you have should be utilized against your basic exemption limit first to the extent of the slab concept, which means whatever slab incomes you have, you can put that slab incomes into basic exemption limit. At any stage, if you do not have enough slab incomes, if your slab income is less and you are not able to utilize it properly, please go ahead and use your capital gains for it. Yes, so income tax basically comes and says, first of all, whatever incomes you have, split your incomes into slab and capital gains. If you are able to utilize your slab against your basic exemption limit, go forward. If at any point of time your basic exemption limit, the 2 lakh 50, the 3 lakh, the 5 lakh or the 4 lakh has not been utilized properly, you can now consume your capital gains for it. But at any point of time, no utilization will take place from your winnings and unexplained income. Yes, so no utilization will take place from your winnings and unexplained income, which means income tax has made it extremely clear that when it comes to winnings and unexplained income, that cannot be sent to your slab, which means even if the slab gets wasted, it is wasted. I am not giving you that benefit no matter what. You are not getting the benefit against your winnings and utilization in unexplained income. These are not getting any kind of benefits whatsoever. You will have to pay tax on that at always. You will have to pay tax on that always, and that's what the understanding is. Clear with me on this, my friends? Be very, very careful. Yes. So Kaju Katli effect is only applicable for residents, and if a resident is going to have any such incomes, resident is going to pay tax on slab incomes first under the basic exemption limit. If you're not able to utilize your slabs, you can use your capital gains, but do not utilize your basic exemption limit for winnings and unexplained income. They are not allowed. Clear? Very good. With that understanding, people, I'm moving on forward. I'm at question number 6. We are now starting with a newer chapter, residential status. Residential status chapter is now coming and saying residential status of a person of Indian origin who has not visited India in the previous year. The person has not visited India in the previous year at all, is earning an Indian income of 18 lakh rupees and is not liable to tax in any country. Yes, now this is where students end up making a small error, because notice, first things is, when you say that I don't have any kind of visit in India, when there is no visit in India happening, the first things which you're going to tell yourself is, Rahul, when there is no visit happening in India, there is no stay in India. Yes, with no stay in India, no matter what happens, even if you don't have one stay in India, you need to minimum have 60 days. When nothing is happening, the first impression is very simple. You are a non-resident. Yes, but then we come to a different provision. The provision comes and says, if you are not a resident in any country, and at any point of time, if your Indian income is more than 15 lakhs, but you're not liable to tax in any country, I am going to declare you as a deemed resident, RNOR. That is what the provision is. And at this stage, this is what students end up making a mistake on. Looking at this line, they say no stay, Indian income is 18 lakhs, person is not liable to tax in any country, let's declare him RNOR. No, 0 marks, 0 marks. This person is a non-resident. This person is a non-resident. What is the issue, Rahul? Why is the deemed residency not applying? Because the person is of Indian origin. For deemed residency to apply, the condition is it should be an Indian citizen. it should be an Indian citizen, which means a person who is not an Indian citizen does not fall into deemed residency condition. Deemed residency is only for Indian citizen. That is the condition, and that's where students make a horrible mistake. Please be careful. Deemed residency ka provision only applies for Indian citizen, not for person origin. Yes, so deemed residency is only for Indian citizen, which means in this conversation, despite the fact that his Indian income is more than 15 lakhs, despite the fact that he's not liable to tax in any country, I cannot declare him as a resident. He will have to become a non-resident only. That's the understanding on this part. Clear? Very good. With that understanding, people, I'm moving on forward. I'm at question number 7. Question number 7 says, when a payment is made by NR to NR, when a payment is made by NR to NR, will you tax interest, royalty and FTS? That's the question. Now, if you understand residential status a little bit, residential status has come and told when it comes to 3 payments, passive incomes of interest, royalty and FTS, payments are only taxable in India when they are used for business reasons in India or other reasons in India. Yes, so in a conversation of NR to NR, I am not bothered who is the payer, I am not bothered who is the receiver. I am only bothered about one thing. The question is, am I going to utilize the services in India? Notice the first line comes and says the business purpose is in India. When the utilization is happening in India, all incomes are taxable in India. You cannot avoid this transaction, which means whether it is royalty, whether it is interest, whether it is FTS, the answer becomes taxable. The answer becomes taxable. Clear? Yes. However, when it comes to other reasons, if you come and tell me that Rahul, I'm going to use the money for utilization to earn dividends, like basically IFOS income, in that case, royalty and FTS says, I don't care. The moment the utilization is happening in India, whether it is happening for a business reason or it is happening for another reason, it is taxable in India. But when it comes to interest, there is a problem. Income tax has come and clarified, any payments happening from NR to NR will only be taxable in India if it is for business reason in India. Once again, any payment happening from NR to NR will only be taxable in India if it is used for business reason in India. This is not a business reason. This is other reasons, investment conditions, and therefore interest has a specific rule, will not be taxable in India. Will not be taxable in India. So this is one adjustment, because of this I gave it to you people. Be very, very careful about this. Royalty and FTS says any reason in India is taxable, but interest says only business reason in India is taxable. Other reasons are exempt from tax and therefore cannot be taxed in India when it is NR to NR. Clear with me on this conversation? Yes. Chalo. Very good. Then comes your tricky one, people, the one which people generally don't read and miss out in examination because you get it in scope of total income. I am at question number 8, which says, what are the 5 cases when the business connection is not established? Can you help me out, people? What are the 5 cases when business connection is not established? Case number 1, when it is not attributable to operations in India. Yes, when it is not attributable to operations in India. Income tax has come and clarified. When the activity has nothing to do with India, then the income is also not taxable in India. Please don't bug India for it. Second, when it is purchase of India. When it is purchase in India for export purposes. If you are going to buy things in India and then export it out of India, India is extremely happy with you because you are getting foreign reserves for me, not taxable. Third, if it is any kind of collection of news and views in India, if it is collection of news and views in India for transmission outside India. You remember, people, for those who have read it in my class, you remember the Indira Gandhi, Rajiv Gandhi case which I showed it to you. That's the funny thing, which was because of which this amendment was introduced. Income tax said any kind of news and views going outside India has no tax in India. Fourth one is shooting of, what is it, people? It is shooting of cinema film by a non-resident. Any non-resident coming to India and shooting cinemas in India will not be taxable in India because it's going to promote tourism. And the final one, if you remember, is going to be display of uncut and unassorted diamonds. Yes, so display of uncut and unassorted diamonds. Now, if you remember, people, the last line is more critical. It is display of uncut and unassorted diamonds by a foreign company. Not everyone is going to get this exemption. It is only an exemption for a foreign company. Only foreign companies are exempted from this transaction of yes or no. Yes, that is what the understanding is. Clear with me on this understanding? Chalo. That is what case number 8 is, people. Let's move on to case number 9. Case number 9 comes and says agricultural income which is received from Lahore. Any agriculture income which is received from Lahore by an ROR and NR, and that is what the conversation is. Now, it looks like the most funniest things to do, people, but unfortunately, I don't know why people make a mistake on this. Look very carefully. First of all, when you see an agricultural land, the rule in India is that agricultural land is only tax exempt in India when it is from Indian lands, which means land coming from Lahore is Pakistan. Pakistan outside India will be taxable in India. And therefore, Mr. ROR is going to say, I'm sorry, I cannot avoid this thing. ROR is fully taxable. ROR is fully taxable. The problem comes when you get the same question in NR logic. Now, people have this general understanding that Rahul, agriculture land, India region exempt. Agriculture land, foreign region taxable. Yes, I agree, no doubts about it. But look very carefully. First of all, I am an NR. And as an NR, there is only 4 incomes which can be taxed to me, which is income received in India, income deemed to receive in India, income accruing or arising in India, and income deemed to accrue or arise in India. In this scenario, the first things which you need to notice is land is in Lahore, which means income is accrued outside India. No mention about the income receipt. I would assume that is also outside India. So when the basic condition itself has not been fulfilled, there is no reason for you to come and say that it is taxable in India, which means for an NR, the answer is going to be not taxable, not because of anything else, but the fact that our basic condition itself has not been fulfilled. When you did not put them into the 4 buckets, there is no reason that an NR can be taxing it in India just because it is a foreign land. No. People, foreign land is also taxable only when it is received in India or has a condition fulfillment. There is no condition fulfillment. There is no reason for you to tax it in India. So yes, this is not permitted. Clear with me on this. Be very smart on this. This is a very small adjustment and a very minute thing which students end up making mistakes on. I hope you got the right answer on this. Yes? Chalo. Let's move on forward, people. The last adjustment when it comes to your residential status. Adjustment number 10 says interest is received by ROR from a non-resident external account of 90,000 rupees. A very small, a beautiful adjustment, and for some reason everyone gets it wrong. Yes, I know. I see the word ROR. The first things which you come and say, Rahul, ROR to EG, no, global income is taxable. Why are you questioning this? No. Understand, people, there is a special exemption given in income tax which comes and clarifies any income coming from non-resident external account. I'm repeating myself. Any income coming from non-resident external account is exempt from tax. It may be taxable. It doesn't matter because global income is taxable, but income tax is given a special exemption even for an ROR. Even an ROR has got that exemption, people, which means this is exempt from tax. This is exempt from tax. Now this is a very small thing. It's a very small thing but has so much impact in examination because I've seen this coming in so many times in examination, especially in return filing chapter. I will suddenly give you a question and the question will come and say, I have received interest on NRE account of 5 lakh rupees from an interest on NRE account which is 5 lakh rupees. Should I file a return? Students look at 5 lakh and they come and say, yeah, basic exemption limit is crossed, please file return. No. People, NRE income itself was exempt. When the NRE income itself was exempt, technically my income is now 0. With my income itself being 0, there is no reason for me to file a return in India. I can straight out say the whole income is exempt, no return to be filed, matter over. That's the impact here. Yes, to be very careful on this. A non-resident external account has been confirmed to be a completely exempted account, and therefore any interest coming from that is exempt even for an ROR. That is the understanding for you to keep in mind. Clear? Yes, please go back and check your exemptions chapter. You'll find it there. If you don't have it there, please watch it out once again. Very important. Clear? Good. 10 adjustments done, people. We're done with 2 chapters of your income tax. I hope you're having a great time looking into this. I hope by now you have got some good answers in your hand and your marks are really doing well. If not, no worries. This is a good opportunity for you to correct yourself and make sure that you don't make these adjustment mistakes in your examination. So please note down every single thing very carefully so that you don't get this wrong anymore. Yes, 40 more adjustments to go, healthy chapters to discuss. Let's proceed on forward in the same pattern and the same pace. We are moving on, people. We are looking at the salaries chapter, the fun part of it. The salaries chapter, like one adjustment which I think students end up making very silly mistakes in exam, and therefore I've put it out for you. The question on PF. The question says, my basic salary has been confirmed as 9.2 lakhs and my DA has been confirmed as 4.6 lakhs, but 40% is forming part. Now the question comes and says, I have received the following contributions. The contribution says, I have an RPF from an employer of 20% of basic salary. Then I have an interest from RPF of 1,30,000, which is 13%. This may look the most simplest adjustment, but cause a lot of mistakes in examination, because I know some people have this thought. Some people have learnt it very immaturely. The rules basically come and say that any contribution to PF is exempt after 12 is exempt up to 12%, and therefore the first thing which a student will do is student will come and say, "Ha Rahul, to ठीक है, let's do one thing. 8% is taxable." So you said 20% you received, 20% you received, 12% is exempt, 8% is taxable. 0 marks, absolutely 0 marks. No mark will be given to you. Notice very carefully. Income tax does not say 12% is exempt. Income tax says 12% of salary is exempt, and that's the difference. The difference is that here they have given 20% of basic salary, whereas PF says it is 12% of salary definition, and salary definition under PF is basic plus DA forming part plus turnover commission, which means unless you take all the three components, your salary definition is wrong. If you just use the basic as a condition, you are making a horrible mistake in examination, and that's something to be paid attention to. So yes, let's do this carefully. The first things I'm going to tell you people is that because the question is asked me for PF, the first suggestion I've made in my class also to all my students is never do PF based on percentage. Always do PF based on full numbers. You do it based on full numbers, you will always get the right answer. So I'm going to first ask a simple question. What is the actual contribution? The actual contribution in this case is going to be 20% of 9.2 lakhs, and 20% of 9.2 lakhs is going to look like 9,20,000 into 20%. Answer is 1,84,000. Yes, so 1,84,000 is going to be my actual contribution. Clear, not clear? Now comes the important part. Please look, I am going to exempt what? I am going to exempt 12% of 9.2 lakhs plus the 40% of 4.6 lakhs. Plus the 40% of 4.6 lakhs. Correct, Ilya? Yes, people, salary definition is what? Basic pay plus DA forming part. DA forming part is 40% of 4.6. So that is what the answer should be, which means I'm going to say first 4,60,000 may say 40% is the number, which is 1,84,000. From that 1,84,000, I will now add my 9,20,000 basic salary, which is 11,04,000. I think I've done this right. Let me check once again. What is going to happen? I'm going to say 4,60,000 multiplied with 40%. The answer has come to 1,84,000. 1,84,000 may I will add the 9,20,000 which I have. Answer is 11,04,000. In this 11,04,000, I am exempted for 12%. The answer is 132,480. The answer is 132,480, and that is what the final answer should be. Yes, so this is what is your computation, people, which you should have done properly. So 132,480 is what you are exempted for, which means taxable amount should be what? I have 1,84,000, right? Yes, so 1,32,840 minus 1,84,000. The answer should come to 51,520. The answer should come to 51,520, and this is the right answer, people. If you make a horrible mistake of coming and saying, Rahul, let's tax 8%, you know what you're going to do? You're going to say, let's tax 9,20,000. So 9,20,000 may say 8% I'm going to tax. You're going to end up taxing 73,600. You think 73,600 is the right answer? No, 73,600 was never the right answer, because you cannot do 8% of basic. You have to do 8% of nothing, because technically that percentage itself is wrong. 20 itself is a wrong percentage, because 20 is given on basic salary. So never calculate it on percentage levels. Always calculate it on full values. Be very careful. Yes, now coming to the interest part. This is the next mistake which students make. Now, people are aware about the fact that you are exempted up to 9.5%, but they don't use their head. They don't understand what 9.5% means. Look very carefully. 9.5% is the interest rate, which means mistakes which you're going to make. Mistake number one, you will say, Rahul, 13% ka number is given, so let's do 1,30,000 ka 9.5. No, people, 1,30,000 is not 9.5. 1,30,000 itself is the interest amount. Interest amount in your hand is 1,30,000, which is calculated at 13%, which means you cannot do 9.5% of 1,30,000. Mistake number two, you cannot say let's do 9.5% of salary. It is 9.5% of interest rate, and therefore you need to look at this calculation carefully. The calculation is, first you will come and ask, how much interest did I get? I got an interest at the rate of 13%, which is 1,30,000. So let's learn to understand the question first. First, the 1,30,000 given to you is at the rate of 13%, which means I put, let's say for example, 10 lakh rupees. When I put 10 lakh rupees, 13% came to 1,30,000, and that's the computation, which means now I will say I am exempt up to 9.5% of the interest rate. Be very careful, which means now what I'm going to say, if I am going to have 13% giving me 1,30,000, how much will 9.5% give me? Look very carefully. What have I done? I've said at 13% interest, Rahul earned 1,30,000. So how much did Rahul earn at 9.5%? Very obviously, Rahul earned 95,000. Yes or no? And that's the exemption amount. The exemption amount here is 95,000 rupees, giving me a taxable amount of 40,000 if I get this right. So it's going to be 1,35,000 minus 90,000. No, it's 1,30,000, right? Yes, sorry, it's 1,30,000 minus 95,000. Minus 95,000, answer comes to 35,000, and 35,000 is my right answer. 35,000 is my right answer. I hope you got this right, people. Clear enough to go? Any doubts on this part? Be very, very careful on this adjustment of. Good to go? Yes? Perfect. Now comes this 12th one. Now 12th one is again another thing which students end up making horrible mistakes because they don't read the laws carefully. Question says, I have a commuted pension of 50%, which is giving me 5 lakh rupees. And the question says the person has received gratuity, which means they're simply asking you what is a taxable pension. Now, everyone remembers the law that when it comes to the question says whenever you receive gratuity, pension exemption is 1/3. But they don't understand 1/3 is not 1/3 of 5 lakh rupees. It is 1/3 of the total pension. And that's where the mistake happens. Look very carefully. The 5 lakh rupees which is given to you in the question is not the total pension. It is the pension which you got when you surrendered 50%. Total pension matlab, what is the pension you would have got had you surrendered 100%? If you would have come and told, give me the full computation, 100% pension vano, what is the number you would have got? That is called as total pension. And therefore, in a pension question, the first and the most important thing is for you to first figure out what is the total pension. Because doing this is what is going to fetch you the mark. Mistake here is where the problem comes. First things you will say, Rahul, I got 50% amount redeemed for 5 lakh rupees. So what is that I will get for 100%? Is very simple. You will say 5 lakh rupees divided by 50% is a redemption amount, which means amount which I am going to get is going to be 10 lakh rupees. Had I redeemed the whole amount, I would have got 10 lakh rupees in my hand, is step number 1. Any doubts on this part? Yes. Now I will move on forward. I will ask the simple question. How much is the pension did you receive? I will say very simple. Rahul, I received 5 lakh rupees. Now you will come and say less exempt of 1/3 of the total pension, not the 5 lakhs, the total pension. So I'm going to exempt 1/3 of 10 lakh rupees, giving me a exempt amount on this is going to be 3,33,333, which means my taxable amount is going to be 1,66,667. This is the right answer. This is what you should have got. If you've got this right, amazing job. Not got this right, small mistake. Clear? Yes, so be very careful, people. It is not 1/3 of the total, 1/3 of commuted pension. It is 1/3 of total pension. Clear? Yes, very good. With that understanding, people, I'm moving on forward. I'm at question number 13. Question number 13 says, I have bought a car by the employer on 10th August 23 for 10 lakh rupees, which is being used by employee. Very important. Question says, employer has bought a car and has given to the employee for usage. First rule, usage perquisite has come into picture. Next question says, finally, this car has been sold to employee on 9th August 25 for 2 lakh rupees. Here is the mistake. Very, very silently, ICI plays the most smartest adjustment where students are focusing on the sale part. Students have realized that the employee has been given the asset on 9th August, so let's do sale computation. What they have not realized is before 9th August also, the asset was in the name of employee only, which means employee was using it before 9th August also, and therefore, first of all, before 9th August, there is already a usage perk. And therefore, what you need to realize one thing is, people, two things are happening in this question. One, that before 9th August 25, there is actually a usage perk. Correct. Yes, up to 9th August, at least I was using it. No, so there is a usage perk coming in. And then after 9th August 25, there is a sale perk which is coming into picture. We call it sale of a movable asset, which means in this question, you have to do two computations, one for usage purpose, one for sale purpose. I hope you get this right. Yes. So what is happening, people? First, let's calculate the usage perk. So first I'm going to ask a very simple question. What is the usage of the asset? Asset was by employer given to employee. When an employee gets a motor car, you ask a very simple question. Is it for personal reason? Is it for official reason? Is it for part personal or part official reason? That is the question which is being asked. In this question, nothing is given. I'm going to assume that it is fully personal. Yes, when no information given to me, I have to assume this is fully personal, because if I don't do that, then I'll have to ask additional questions, 1600, non 1600, all those things and all. I'm assuming fully personal. Now, when a motor car is given to you for fully personal purposes, income tax says if the car is bought by the employer, the perquisite is 10% of the cost of the car, original cost, which means I am going to take it as 10% of 10 lakh rupees. I'm going to take it as 10% of 10 lakhs. But here is a mistake. Notice carefully. Because the asset has been sold to the employer on 9th August, I would have technically used the asset only till 8th August. So I should only give you perquisite calculation till 8th August. Why should I calculate anything more than 8th August? Yes or no? So first I'll have to calculate the number of days. So I have done a small calculation here. April I used fully 30. May I used fully 31. June I used fully 30. July I used fully 31. August is coming in for only 8 days, which means my calculation stops at 130 days. So I will say 130 days is what I'm going to pay the perquisite for. I am not going to take a single rupee more than that. After 9th August, anyway, the asset is mine. When the asset itself has become mine, why the earth should I take the asset into calculation? Yes or no? And therefore, the answer is 130 into 365. Let's see what the answer comes to. I'm going to take 10 lakhs. So it is going to be 1 lakh. 1 lakh may. I'm going to do 130 divided by 365. Answer is going to come as 35,616. Answer is going to come to 35,616, and that's what the calculation is. Clear with me on this? Yes, yes, very good. Now you have to look at this one carefully, because here you are going to make a mistake. Question is on sale perk. Question is on sale perk. People, now the car has been given off to the employee. When the car has been given off to the employee, the asset has been sold off, and when an asset of car nature has been sold off, the sale of mobile assets definition comes and says that you need to first calculate the WDV today after using 20% depreciation on a WDV model for every completed years of usage. For every completed years of usage. And here is where you're going to make a mistake. First things I'm going to take that I first have to calculate the depreciation. So I'm going to do 10 lakhs minus 20% depreciation for how many years? And that's the question. Very important question. How many years ka depreciation I have to take? Understand this carefully. Question said, I want every completed years of usage. Now, in this conversation, asset has been used from 10th August 23 to 9th August 24, 1 year. Then asset has been used from 10th August 24 till 8th August 25. People, 9th August ko to sale ho gaya. The sale has been happened on 9th August, which means technically asset usage has happened like this. Look very carefully. I have come and told from 10th August 23 to 9th August 24, there was 1 year. Correct. Then from what happened, I again went from 10th August 24 till 8th August 25, only the asset was used. Tell me, people, have I completed the usage? Have I completed the usage? No. This looks like 364 days. This does not look like 365 days. And 364 days means the usage has not been completed. I have only utilized it for one completed year. It is one completed year and 364 days. Income tax says ignore any kind of percentages, which means answer is for 1 year alone. Answer is for 1 year alone, and this is the mistake which you end up making. If you end up calculating depreciation for 2 years, it's a lost case. You cannot calculate depreciation for 2 years. Depreciation is only for 1 year. I cannot give you depreciation more than that. Depreciation can only be given for 1 year, which is nothing but the period of FY, which is from the period of 10th August 23 to 9th August 24. This is the period I have to stop. I cannot give you more than that, because 9th August ko to asset came to you, which means sale has taken place before the completion of the year, and I will not give you depreciation whatsoever. Only 1 year depreciation is given to you. 10 lakhs may say 20% gone, which means 8 lakh rupees is the worth of the asset. which means you should have sold it to the employee for 8 lakh rupees, but you ended up selling this to the employee for only 2 lakh rupees. Because you sold it for 2 lakh rupees, what will I say? Less amount recovered. Yes, income tax will say, my dear employee, you should have got the asset for 2 lakh rupees, but you should have got the asset for 8 lakh rupees, but you ended up paying only 2 lakh rupees. So difference is 6 lakh rupees taxable for you. Difference is 6 lakh rupees, which is the taxable perk for you. That is the answer. Clear? Yes, this is what the mistake you're going to make. So be very, very careful on this adjustment. If you've got this right, good job. Definitely good job. Yes, very good. Chalo, that is what the understanding is, people. I hope you're able to get this out. Clear? Perfect. Next comes your 14, something which has not been tested in examination more than once in the past, but should be tested in examination. The question says, what is the RFA rules if the employee is going to receive it for more than 1 year? An amendment of 2021, people, which basically came and clarified that when a person is going to use RFA for more than 1 year, in the second year, I do not end up calculating RFA one way alone. I will not come and say it is 10% of salary alone. No, I will have to do indexation of RFA and get the computation. So which means the rule is like, in the RFA for second year, in the RFA for second year, the answer is basically, what is the RFA for first year indexed? I'm going to say, what is the RFA for first year indexed? Or the current year RFA, which is basically the house property plus the furniture, which is basically RFA for first year, whichever is lower. Yes, this is how the rules are, people. The rules basically come and say, if you're going to have RFA for more than 1 year, the understanding is that you have to take RFA for the first year, which is indexed off, and then RFA for current year calculated. Let me put it as RFA for second year calculated. RFA for second year calculated, whichever is lower, and that's the computation which you have to keep in mind. This is how it works, people, which means here you will have additional efforts to put. You will first have to calculate what is RFA for current year. You will also have to calculate what is RFA for last year and then index it off in the current year. Now, I am assuming you understand what indexation means, but if you don't understand indexation, let me put it out also for you. Indexation means RFA into CII for year 2 divided by CII for year 1, obviously. That is how it works. Simple. This is your capital gains indexation, people. The same logic applies here. So income tax is coming and saying, whatever indexation you have done in year 2, take the same indexation and do it for year 1 as well. So it is indexation for year 2 divided by indexation of year 1, and that's how the calculation will look like. Clear with me on this, people? Be very, very careful and smart on this. I don't know, for some reason ICA has never tested this, but if ICA does end up testing it, it will make a lot of mistakes in exam. So be very, very careful on this computation. Clear? Yes, very good. Next question, people. It says, what is the motor car given for part personal and part official reasons? What is the perquisite rules if the motor car is given for part personal, part official reason? Now, I'm going to simply calculate a table, people. I think you know this table from my material, but if you have not done it earlier, I'm going to show it to you. The table is like this. I'm going to basically come and ask a very simple question. Tell me, whose car is it? Tell me whose car is it? And next question I'm going to ask, what is the running and maintenance incurred? Who is going to incur the running and maintenance? That is the question I will ask, and based on that I'll give you the taxability on this. Yes, this is a very simple thing, people. I'm assuming you would have done this 101 times, so please be careful about this. The rules are very simple. If the car owner is employer, but the running and maintenance is maintained by employee, employee is going to bear the running and maintenance. I'm only going to give the car. Income tax says, please simply tax 600 per month or 900 per month. Please simply tax 600 per month or 900 per month. Next, I'm going to say, if the car is owned by employer and the running and maintenance is also run by employer, income tax says simply tax 1800 per month or 2400 per month. Now, I am assuming you know why it is 1800 and 600, 900 and all, people. The 1600cc condition is there. So I hope you get that right. Yes. So that is what the understanding is. Third, I am coming and saying, if the owner is an employee, but running and maintenance is met by employer, matlab car is mine, of a company will only give me running and maintenance. In that case, income tax says, take the full running and maintenance, but reduce 1800 per month or 2400 per month. Correct, not correct. That is what the conversation is. Yes, so be very careful on this. Income tax comes and says in the first two scenarios, it is 600 per month or 900 per month taxable. In the second scenario, it is 1800 and 2400 taxable. But in third scenario, it is R&M fully taxable minus the 1800 and 2400 per month. Yes, separately income tax says if at all a driver is given. If at all a driver is given, simply add 900 per month. Simply add 900 per month. But problem comes in the second one. In the last one, people, and last one is where you end up making small errors. So I'm going to probably show it a little separately so that you understand this better. Income tax is come and told if at any scenario a driver is given in the third case. If at any scenario the driver is given in the third case, what will happen, people? Income tax will say if a driver is given to you, then what will happen? I will go reverse. In the previous one, what did I do? I taxed 900 per month, but here income tax will say if driver is given, then it is driver salary is fully taxable. You will tax the full driver salary, but then you will exempt 900 per month in it. Yes, please be very careful. In this conversation, 900 per month is taxable. Whereas in this conversation, 900 per month is exempt. Yes, so notice how it changes very significantly, which means in the previous one, let's say for example, even if you give 4,000 rupees to the driver, I will only tax 900 rupees. But in this conversation, if I give 4,000 to the driver, the full 4,000 is taxable, 900 alone is exempt from tax, and that's how the conversation is. Yes, to be extremely careful on this conversation, be very, very smart on this understanding. Final, people, I think there is no rule there, but you know this. If the car is owned by employee and the running and maintenance is also taken care by the employee, I will simply say there is no perk itself. Nothing to be worried, no calculation to be done. This is not taxable at all. One adjustment which has always been tested in examination, but this one is something to be very, very careful about. The fact that if you are going to have a driver given along with running and maintenance, but car is by employee, in that case, tax the full driver salary and exempt 900 per month. That's the conversation to be kept in mind. Clear on this part? Yes, so be very, very careful on this understanding. Yes, I'm going to put this also in red so that it makes it easier for you, and that's how the understanding should be. Clear? Yes, perfect. I think this is the last few questions. Question says professional tax under ATR and DTR. What are the rules for professional tax in ATR and DTR? The answer is fairly simple. Let me first come and tell you what is the rules to be kept in mind. Rules to be kept in mind is first figure out who is paying the professional tax. If you tell me that the professional tax is paid by employer, if you tell me the professional tax is paid by employer, income tax will say, first of all to add it as perk. And then claim a deduction. First of all, to add it as perk and claim as deduction. Understand, people, who should have paid professional tax? Employee. Who paid professional tax? Employer. Because employer paid the professional tax, income tax will say first to add it as perk because employer paid your money. And second, you can claim it as deduction because anyway it is paid off, it has gone to state, so you can claim a deduction. Yes, but if the employee is paying the money, if the payment has happened directly by employee, then there is nothing to be done, simply claim a deduction. Simply claim a deduction, and that's how the computation will look like. I hope you get this computation right, people. This is what the understanding is. And by the way, this is under ATR rules. This is under ATR rules. Clear enough? Yes. Now I'm moving to DTR. And this is where you have to be very, very careful on what is happening. Income tax has come and told, my dear child, if you are under DTR, only one thing has been taken away. The deductions has been taken away, which means the taxability part has not changed. The deduction alone has changed, which means under DTR rules, I'm simply going to say, if it is paid by employer, I am going to say simply add to perk, full stop. Meaning income tax will say tax da, put it under perquisite and tax it because employee ka paisa employer has paid. But will you get deduction? No. No deduction is coming to you. If employee is paying, people, anyway nothing was to be added. Deduction was the only thing to be done. I'm going to say simply ignore. Which means nothing is going to happen under DTR for this because anyway no deduction is to be granted. And this is what the difference is when it comes to ATR and DTR. Yes, that is the understanding for you to keep in mind. Any doubts on this part, my friends? Clear enough to go? Yes? Good. Now I'm moving to question number 17. Question number 17 is a hint from your Jan 2026 exams. While I don't agree to this, but yes, Jan 2026 has come and given this confirmation to you. So you're going to work with this. Question is, I am an employee of a government company. Am I eligible for entertainment allowance? Am I eligible for entertainment allowance? For those who remember, people, when you go to deductions, deductions come and says, if you're a government employee will get a deduction of entertainment allowance. And so the question is government employee the same as employee of government company? I'm repeating myself. Is government employee the same as employee of government company? The answer is no. The answer is no. ICA has given a confirmation saying government company employee. ICA has given a confirmation saying government company employee is not a government employee. Yes. Now, I don't agree to this very honestly, people, because then my question is very simple. What are those people who are called government employees is a question mark which has come up right now. But for some reason, this is the commitment which ICA has given. So we're going to follow it as it is. The answer is a big fat no. I'm sorry. I am not giving you entertainment allowance deduction because you are not a government employee. You are an employee of a government company. Different things apparently from ICA perspective. So yes, you have to keep that in mind. Clear enough on this? Good enough to go? Chalo. With that, people, I'm moving on to question number 18. Question number 18 says, an employee who has joined on 1st February 24. Notice the dates very carefully. And I've told this in my class also. Dates are extremely important. So be very careful. Question says, an employee who has joined on 1st February 24 for 10,000 rupees, 3,000 rupees and 25,000 rupees. His basic salary for financial year 25-26 is what? Now, if you know this, people, we call it pay scale model. And pay scale model is where you have to be a little careful, because pay scale model basically comes and says 10,000 is my starting point. Starting point when I joined the company, which means I joined the company on 1st February. So from 1st February, Rahul is receiving 10,000 rupees. But 3,000 rupees will be my increment in the next cycle. The moment I complete 1 year, I will get a 3,000 increment. Next year, I will again get a 3,000 increment. Next year, I'll again get a 3,000 increment, and this will go on until I reach 25,000. Yes, which means you need to first figure out the dates very, very carefully. Look, understand this carefully. My joining has been 1st February 24, which means what is going to happen? From 1st February 24 till 31st January 25. From 1st February 24 till 31st January 25 is my first year, in which case I would have got a 10,000 rupees ka salary. Agreed? Yes. Next, I am telling from 1st February 25 to 31st January 26, I would have got an increment right now. My increment would have come and my increment would have been 3,000 rupees, making my salary as 13,000 rupees. Correct? Yes. And finally, when I'm moving from 1st February 26 to 31st January 27, I would have got my next level of increment, which is 16,000 rupees. Correct? Now comes the problem. Look very carefully. First things which people have to understand is that a pay scale model is never per annum, it is per month, which means these are my per month salaries. And at that stage, I now have to ask, what is my first financial year data? Question is asking for financial year 25-26. Now, my financial year 25-26, matlab it is from 1st February 25 to 31st March 26. Look very carefully. Yes. So from 1st April 25 to 31st March 26 sits under which bucket is the question. Look carefully and tell me, will my 10,000 be covered here? Answer is no. 10,000 is only for the period 31st January 25, before my period itself. 1st February 25 say 31st January 26 mein, yes, my year is getting covered. So there are some months which are getting covered here from April, which means April I would have been receiving 13,000 ka salary. And this would have continued until I reached January. So January tak I would have received 13,000 ka salary, which means I am going to receive 13,000 rupees of salary for the period April to January, which means I'm going to receive it for 10 months. Plus, next what happened? February again I got an increment. This is my third cycle of increment. In the third cycle of increment, I would have got 16,000 rupees, and this 16,000 rupees is going on for the full year, but I only need it till March, and therefore this is the number which is going to come to me, which means this is my final answer. This is my final answer, and this is how the computation will look like. Clear enough to go? Yes. With this understanding, people, I can confirm to you my let's say put it as 13,000 into 10 is going to give me 1,30,000. 1,30,000 pay. I'm going to add another 32,000 because 16,000 for 2 months, which is 32,000. Answer has come to 1,62,000. So 1,62,000 is my basic salary for you to keep in mind. Yes, this is how you do a pay scale model, and this is what you have to keep in mind, because this is where you're going to make a mistake in examination. So be extremely careful. Clear? Yes. Beautiful. Next, people, the last thing, the amendment of current year, and therefore I've put it off. The amendment of the current year comes and says, education facilities provided to the son of employee with a salary of 3 lakh 50. Be very, very careful. Question says the my salary is 3 lakh 50. Current year amendment comes and clarifies that if a person has a salary less than 4 lakh rupees, if a person has a salary less than 4 lakh rupees, he will not be considered a specified employee, which means I'm going to confirm saying this person is not a specified employee. And if the person is not a specified employee, there are some perquisites which are not taxable to him. If you remember this, people, yes, there are some perquisites which are not taxable for a non-specified employee. Items like education facility, giving him a car, giving him water, servant, electricity charges and all are not taxable to him, which means as a 3 lakh 50 person non-specified employee, giving away education facility is technically not taxable provided company gives the benefit. The same rules come and tell you that if the company is not giving the benefit but is rather giving you reimbursement, then it is taxable no matter what. Yes, to be extremely careful on this understanding, the understanding that if the company is going to give you reimbursement, then it is taxable for every party. But if it is not going to give a reimbursement, then it is taxable only for specified employees. So I am going to read the question carefully. It says direct payment made to school by the employer for 3,000 rupees. Now, when the company itself is making a direct payment, then education facility anyway is not taxable because now benefit has been directly given. So therefore, this will become fully exempt. This will become fully exempt. I remember telling this in class also that this is an MCQ question expected in exam, so be careful about it. Next part is the critical part. It says reimbursement by the employer to employee of 3,000 per month. Now, what is happening? Company is not giving the money to the school directly. Company is giving it to the employee. When the company is giving to the employee, income tax will say taxable pa if education facility rules are applied. Rules come and say when you give any kind of education facility to a son, cost of education should not exceed 1,000 per month. If the cost is exceeding 1,000 per month, I am going to ask you tax on it, and therefore this will become taxable. This is going to become taxable since it is crossing 1,000 per month. Since it is crossing 1,000 per month. Clear enough to go? Yes. Now, people, in this conversation, imagine if the 3,000 rupees would have been 900 rupees. Would I have taxed this conversation? No. Then I would come and say, despite the fact that it's reimbursement, the reimbursement is not exceeding 1,000 per month and the education facility rule says it has to not cross 1,000. I would give it exempt, which means in this conversation, it is only taxable because the cost of education has increased. And yes, it is a reimbursement. Because it was not a reimbursement and direct benefit, the first conversation became exempt despite the fact that it would have been taxable otherwise. Yes. So this is what the amendment of exam is. Be very careful on the amendment of specified employees in current year. Expect a question on that. Clear? Good. With that, people, I'm done with your topic on salaries as well. We have done 19 adjustments. 20th, we are moving on. Shall we? Yes. Beautiful. Let's move on to adjustment number 20. Income from house property adjustment number 20 says vacancy loss will be allowed to what parties? Vacancy allowance will be allowed to what parties? We have done this in class very simply, people. We have come and told when you calculate your GAV, the answer is very simple. It is MV or FR, municipal value or fair rent, whichever is higher, compared with standard rent, whichever is lower. You get your expected rent there. Now, problem is very simple. Expected rent is generally given for full year, whereas actual rent is given only for the respective period because you have a vacancy loss coming into picture. At this stage, we ask a very simple question. We tell boss, don't take your actual rent for the vacancy for the actual period, take your actual rent for the full year, which means I'm going to ask a very simple question. What is your actual rent for the full year? If you tell me my actual rent for the full year is this number, let's say 3 lakh rupees, and at that stage your expected rent is only 2 lakh 50, you will inform the government that, sir, I am a good boy. I am a good boy because I would have given you 3 lakh rupees had vacancy not arisen, which means without the vacancy arising, I would have been a good boy and therefore I need my vacancy loss. Please grant it to me. Income tax will say take it. To understand this one thing carefully, I am coming and telling you that my actual rent ignoring vacancy is 3 lakhs. My expected rent is 2 lakh 50. Government says you are a good boy because you are ready to report me 3 lakhs, but you have made a vacancy, take it away. However, if my actual rent for the full year itself would have been 2 lakhs, whereas my expected rent is showing 2 lakh 50, then government will say, beta, whether you have vacancy or not, you were from the start itself a bad boy only. Because had you gone and given me rent for 2 lakhs of the full year also, I would have still collected tax on 2 lakh 50 because you were anyway a bad boy to me. With that conversation, there is no reason for me to give you vacancy loss. In simple words, vacancy loss is allowed if actual rent for the full year, minus unrealized rent if any. Yes, if you remember people, if you have any unrealized rent, you can reduce it from your actual rent. If you have that, you can reduce it. So it is actual rent for the full year minus unrealized rent if any is greater than expected rent. Yes, this is the only reason that I can give you vacancy loss. If that is not happening, then I'm not giving you vacancy loss. It has to be this answer only. That is the statement for you. Clear with me on this, people? So vacancy loss has been tested in exam multiple times and students don't realize the vacancy loss calculation properly. So be very, very careful. I'm going to give you vacancy loss only if my actual rent for the full year, matlab ignoring vacancy period, minus the unrealized rent has exceeded my ER. Only at that stage can you go back and tell income tax department that, sir, I was trying to be a good boy. Had vacancy not arisen, I would have been a good boy. So please give me the benefit. He will grant you the benefit. If your ER would have shown higher, then government is not giving you the benefit whatsoever. You will have to pay tax on the ER as it is. That is what the answer should be. Clear on this part? Yes, so be careful. Question number 21. Question number 21 says, loan has been taken on 1st August 24. Please notice, not your previous year. Loan has been taken somewhere in the past year. House has been completed on 1st September 25, your previous year. Current year, they have completed the house. Question is simply asking, what is the pre-construction period? This is where the challenge is. Students don't understand or sometimes get mixed up between HP and PGBP. Because in PGBP also we have the concept of borrowing cost. In HP also we have the concept of borrowing cost. But HP rules are different. HP comes and tells you that, my dear child, if a house is completed in the middle of the year, this whole year itself is not considered as pre-construction interest. So look very, very carefully. Income tax is told, if the house is completed in 1 year, then that full year itself is not considered as pre-construction interest. So in this case, despite the fact that the house is completed on 1st September 25, I will assume that this full 25-26 itself is not a previous year. And when 25-26 itself is not a previous year, then I'm going 1 year back. 1 year back, matlab, I am going to stop my calculation on 31st March 2025. And therefore, my pre-construction period in this conversation is going to be my start of the loan, which is 1st August 24 till what we call as 31st March of 25. Till what we call as 31st March of 25. It is not going to be until 1st September, people. It is going to be until 31st March because that is the year prior to the year in which the house is completed. Pre-construction period has a very simple rule. You cannot take the construction completion year. You have to take the year prior to the completion year, and therefore pre-construction period is 31st March 2025. That's what the calculation is. Clear? Yes, very good. Then comes the last question, people, in HP. The question says, what are the HP loss set off rules under ATR and DTR? Yes, now I should have technically put this under set off chapter, but because it's relating to HP, I wanted to put it under HP because, yes, important rules. The rules of set off are very simple. Income tax says, if you're under ATR, step number one is what we call intra-head set off. Step number one is what we call intra-head set off. In simple words, I will set off HP to HP. Simple, straightforward logic. Yes, that is what the understanding is. Step number 2. Income tax says go interhead. Go interhead up to 2 lakh rupees, which means up to 2 lakh rupees you can set off interhead. But if you're not able to set off, simply do one thing. Step number 3, carry forward. You can carry forward for 8 assessment years to set off intrahead. To set off HP, to set off intrahead. Yes, that's the rule, people. The rule is very simple when it comes to DTR scheme. DTR scheme comes and says HP to HP set off permitted. If you're not able to set off HP to HP, simply go and set off against other heads, but maximum restriction of 2 lakh rupees. If you're not able to do that, please carry forward for a period of 8 assessment years to claim the deduction accordingly. Yes, but when it comes to DTR, things are going to get a little ugly. Income taxes, when it comes to DTR, step number 1 is set off intrahead. Step number 1 is set off intrahead, meaning any kind of LOP loss you can have, you can set off against LOP income. That is what. After that, people, nothing else. Nothing else. What is the rule? The rule comes and says, if you are going for DTR, any balance. Can you do interhead set off? DTR says no. I'm sorry, no interhead set offs will be. Can you carry forward? Answer is there also no, which means in simple words, income tax has said any balance will be lapsed. any balance will be lapsed, which means in simple words, income tax has come and clarified to you that, my dear child, in DTR, if you have a loss in current year, please, for the love of God, set off in the current year itself. If you don't have a set off in the current year, you are neither permitting carry forwards, neither permitting any kind of interhead set offs, which means the loss will go forever. Swaha, HP rules, restrictions. Be very, very careful on this adjustment of, which means income tax comes and clarifies any kind of loss which is coming from HP cannot be carried forward whatsoever. If you have an LOP income in current year, please set it off against the current year income itself. If you don't have any LOP income, please wave tata bye bye to it. You will not get it anymore. That's what the rules are. So be very, very careful on that understanding, people, because that is where the answers will change. Clear with me on this conversation? Any doubts on this part? Good enough to go? Perfect. With this, we are done with the HP rules also, people. We are at adjustment number 22. I'm hoping that you're having a good pace on this right now and you're able to get the right answers. If you're having mistakes, good. Trust me when I tell you this, mistakes happening at this stage is very, very good for you, because you're learning a lot of new lessons right now and you're going to do amazingly well in examinations with this understanding of. Now, with that confidence, with that tone, with that kind of speed, we are going to continue with the balanced topics. We are moving on to the topic called as PGBP. Yes? Question 23. Question 23 basically is a very easy question, people, but I feel this is one of the most important adjustments, because in my experience at least, ever since ICAI started asking you questions relating to comprehensive DTR versus ATR, this is one adjustment you've always seen in examinations. Yes, adjustment number 23 is basically asking you to compute and confirm what is the scientific research rules under ATR and DTR. That is what the rules are. Yes, if I have to put this out very simply to you, the answer is fairly very straightforward. The answer is to first figure out what kind of scientific research expenses you have. We have two kind of expenses. One is called in-house R&D expenses and one is called contribution expenses. Yes, meaning one is where I am itself having an in-house expenditure facility and I'm paying money there. Second is where I'm paying money to IITs, IIMs, all those kind of schools, colleges and all, where they are doing scientific research options. That is what I'm talking about. Now, income tax says if you're going to have any in-house R&D, it is allowable under both the regimes. It is allowable under both except for land. Yes, if you remember this provisions, people, income tax basically comes and says any scientific research expenses incurred will be 100% allowed as expenditure, whether it is revenue or capital, except for land, and this provision is there under both the regimes. However, if you have any kind of contributions, contribution is allowable only under ATR. Yes, so the provisions come and say you can claim it only under ATR. DTR may this provision is not allowable. So if you see the adjustment and the adjustment comes and says contribution to scientific research is debited to P&L, you will ask a very simple question. Am I under ATR or am I under DTR? If you tell me you're under ATR, I would say anyway allowable as deduction, it's there in the P&L, ignore adjustment. But if you're under DTR, DTR will say, I'm sorry, I cannot give you this expenditure, so kindly disallow. And that's what the expenditure will look like to you. Any doubts on this part? Yes? Good. Moving on forward, people, the employer and employee contribution, one of the very important adjustments, because this is where students get a little confused in examination. So if you look at this one carefully, income tax says if there is any employer contribution, when employer is contributing money to PF, he needs to pay it before due date of return filing. He has to pay it before due date of return filing. If he does not pay, then he can claim it in the year of payment. Yes, so this is what the provisions are. The provisions basically say when it comes to employer contribution, you have to claim it, you have to pay it before the due date of return filing. If it is late, then you can claim it in the year of payment, and that's what the condition is. This is how you would have learned it, people. Problem comes when it comes to employees contribution. Employee contribution says you have to pay it within the due date of act. Yes, so let's say you are going to say PF, so I'm going to say due date of PF Act. Yes, which is normally 15th of next month. If this goes late, then it is income permanently, which means I am not going to give you the deduction even if paid later on. That is what the conditions are. So this condition basically says, I'm sorry, if you have not paid the money within 15th of next month, then the payment will become an income forever. You will never get the expenditure deduction of this no matter what, and therefore it is considered as income permanently. Be very, very careful. There is no claim in the future years as well. It will become a permanent income for you. That's what the conditions are. Clear with me on this? Yes, be very careful. Next one comes 25. 25 is one of the most trickiest adjustments because students generally end to make mistakes in this. Look very carefully. Question says, I have a bad debt of 5 lakh rupees which is claimed in AY 24-25. Yes, AY 24-25 matlab some past year, not your present year, because you are doing assessment year 26-27. Next, assessing officer only allowed 3 lakh rupees from the same. Matlab that year you had a bad debt of 5 lakhs. When you filed the return, assessing officer said, I am sorry, I am only going to give you 3 lakh rupees. Matlab, in that scenario, you went and told officer, sir, why are you giving me 3 lakhs? I should have asked for 5. Officer said, I will only give 3. You want to agree, you agree, otherwise get lost. Yes, which means you have unfortunately never got the deduction you wanted. You wanted 5, officer gave you 3. At this stage, you're simply going to say, sir, I'm going to keep this in mind. I'm going to keep this in mind that you did not give me 2. I'm going to be very angry about it, but I'm going to keep this in mind that you did not give me 2 lakhs worth of deduction. Now look carefully. Question says, bad debts recovery is 3 lakh rupees in 25-26. In the current year, I have a bad debt recovery of rupees 25-26 3 lakh rupees, which means now what is going to happen? You have a bad debt recovery, you're going to put it in P&L, obviously. At this stage, you're going to play your game very smart. You're going to tell the officer, my dear officer, this year I had a bad debt recovery of 3 lakh rupees. I technically should have taxed the 3 lakh rupees, but I remember this. I remember this one thing that you did not give me the 2 lakh rupees ka deduction in that year. So I am not going to let go. I'm sorry. I have got 3 lakh rupees worth of bad debts recovery in current year. I want 2 lakhs to be exempted in this. Because 2 lakhs was never allowed me in that year, you have to give it to me in this year. I am going to take this from you, which means technically you are going to tell the officer that, sir, I am not going to be taxing the whole 3 lakh rupees which I received in current year. I'm only going to be taxing 2 lakh rupees in the current year. I'm going to be exempting 2 lakh rupees in current year because I already taxed it in that year. Give me taxable amount only 1 lakh. Yes. So with this understanding, people, the first things you need to understand is taxable amount is only 1 lakh rupees. Taxable amount is only 1 lakh rupees. But here is where the problem is. Look very carefully. In your P&L, current year, your P&L amount is showing 3 lakhs, whereas amount should show 1 lakh. Matlab, in my P&L, there is an extra 2 lakhs showing. Because there is an extra 2 lakhs showing, will you offer that much income? No. So you're simply going to say, sir, please reduce 2 lakhs from the P&L. Please reduce 2 lakh from the P&L. I hope you understood what I did, people. Yes. So basically what is happening? I tried to claim 5 lakhs. Officer gave me 3 lakhs. In that scenario, I will tell the officer, sir, I'm going to keep this in mind that you did not give me 2 lakhs worth of deduction. Because you have not given me 2 lakhs worth of deduction, I will claim it in the future. That is my promise to you. In the current year, when you had 3 lakhs worth of income, you went to the officer and said, sir, I wanted that 2 lakhs. You did not give it to me. I want it right now. Matlab, in that 3 lakh worth of income right now, I am going to say 2 lakh was already given in that year. I have already paid tax on the 2 lakh in that year. So I am not going to pay you single rupee tax in the current year for that 2 lakh rupees. Give me exemption of 2 lakhs. I'm ready to offer you 1 lakh because that is what you have extra. I'm ready to give you that 1 lakh rupees, but the 2 lakh is definitely not going to be given to you. I'm not going to give you the 2 lakh rupees. Matlab 3 lakh showing in my P&L is wrong. Reduce of 2 lakhs. That is what the taxable amount should be. Clear on this? That is the provision, people. So be very careful on this. And yes, this is an adjustment which students tend to make a mistake in examination. So be very careful on this adjustment of. Any doubts on this part, my friends? Clear? Good. Then brings the theory question. The theory question is, what is the TDS rules defaults for PGBP? Something which students generally end up making a mistake. So look carefully. First, there are 2 conditions to be fulfilled. Condition number 1. Yes. Condition number 1. My condition number 1 is TDS should be deducted by 31st March of the previous year. Yes, the first condition which income tax has is please deduct the number by 31st March, meaning TDS should have taken place by 31st March. If TDS itself has not taken place by 31st March, there is no option but to disallow. Second, condition number 2. Second, condition number 2 is pay the TDS by the due date of ROI, which most often is going to be 31st October, but I'm just putting it out to you. Yes. So income tax basically comes and says there are 2 conditions to be fulfilled. Condition number 1 is you should have had the TDS deducted by 31st March of previous year. And condition number 2 is you should have paid the TDS by 31st October of the assessment year, which is nothing but the due date of ROI. If you fail to do so, then what are you going to do? You're going to disallow. You're going to disallow 30% for resident payments and 100% for NR payments. Yes, that is what the conditions are, people. So income tax basically comes and says, my dear child, do your job properly. If you're not going to do your job properly, I'm going to disallow 30% for resident payments and 100% for non-resident payments, but claim in the year of depositing TDS. Claim in the year of TDS deposit. Matlab, income tax is saying it's not a permanent disallowance, it's a temporary disallowance. You can claim it in the future year when you end up paying the deposit of TDS. So whenever you deposit the TDS, that time I'll give you the number. Now here is where students end up making a mistake. Look carefully. If the question comes and says, last year I had a payment of 1 lakh on which I did not deduct TDS to residents. Last year you would have only disallowed 30,000 rupees. You would have not disallowed 100%, you would have disallowed only 30,000 rupees. So current year when you make the TDS payment, please don't claim 1 lakh. Please claim only 30,000. You cannot end up claiming 1 lakh because you've already only disallowed 30,000. When you have disallowed 30,000, you're also going to claim only 30,000. You're not going to claim the full 1 lakh rupee. Please be very, very careful. Clear? Yes, yes, good. Next, people, we're moving on to question number 27. Look very carefully. Two adjustments, very critical adjustments, which has come in exam in the past and people have made mistakes on that. Look, it says, first one is payments made to brother-in-law of 50,000 rupees when the fair market value is 30,000 rupees. This is what the adjustment is. Now, people are aware about this. People generally come and say, Rahul, related party transaction, FMV Kamala, if you pay, it is going to be disallowed. No, agree, no doubts. Agreed, but this is the mistake. The mistake which people generally don't remember is the fact that brother-in-law is not even a relative definition. Yes, income tax basically comes and says, when you have a brother-in-law is not going to be part of your relative definition, and because he's not part of relative definition, any payment made to the person will be considered reasonable. Should not be any impact, does not have a problem, which means here answer is going to be ignored. Answer is going to be ignored. Yes, I made a payment which is more than the fair market value, but income tax does not care because income tax says not a related party. I will not disallow anything, nothing to be worried about. Nothing to be worried about. I hope you get this, people. There's one adjustment which you have to be very, very careful about. Adjustment number 2. Adjustment number 2 says sale made to father of 1,50,000 when FMV is 3 lakh rupees. Now here again the same mistake happens. People start using their logics, and I don't deny it. You're absolutely right. Rahul, I should have sold it for 3 lakh rupees where I sold it for 1,50,000, which means I've sold at a lesser price. Let's add the 1,50,000. Yes, what you're saying is perfectly logical, but is not there in the law. Understand the provision carefully. Section 48(2), which we are discussing right now, talks about the fact that when you pay more than the fair market value, excess payment is disallowed. There is no provision whatsoever regarding sales here. There is no sales provision in this whole chapter, and therefore nothing can be done in this, which means even though the fact that father is a related party, despite the fact that father is a related party, this is not an expense. This is not an expense. This is a sale transaction and therefore will not be considered whatsoever, should be ignored. Income tax will say, yes, you have sold for lower price, can't do much about it. Good for you, don't pay tax. That's all we can do, because we don't have a provision on 48(2) for sales. We only have a provision for expenses. Nothing can be done, should be careful. Yes, so 48(2 may two things which are always tested, people, to be very, very careful. The general things which you know, question will say payment made to brother which is unreasonable, you will disallow. Payment made to father unreasonable, disallow. Those things are fair enough. But two adjustments which come in where they say brother-in-law, simply say not a related party to be allowed. Sister-in-law, not a related party to be allowed. Sale transaction, not relevant to income tax, to be ignored. Completely fine. These provisions will not have an impact in PGBP chapter of. Clear? Be very, very careful on this. Any doubts, my friends? Yes? Good. Let's look at adjustment number 28. Adjustment number 28 is a fun trick. Adjustment number 28 says payments made by bearer check and cross check. The first question you need to realize is bearer check and cross check a permissible mode? Answer is no. Income tax has come and clarified that when they spoke about payments, they did not just say cash. They said account paycheck is permitted. Anything other than account paycheck is not a permitted transaction, which means bearer check is not permitted. Cross check is not permitted. Yes, when both the transactions are not a permitted transaction, normally what happens, you say if a payment is made exceeding 10,000 rupees, non-permitted modes should be disallowed. That is what the rules are. Agreed, not agreed. Yes, but here is the problem. Notice carefully, it says the payment is made to transport operator. When the payment is made to transport operator, income tax says you can make the payment up to 35,000. Normally the rule is 10,000 rupees, but transport operator becomes 35,000, which means here the answer is going to be fairly simple. I'm going to say, boss, you have made a payment by non-permitted modes. I will ask a very simple question. If within 35,000 per person per day, yes, maybe let me put it this way. I would rather say, give me 1 second. Let's put it as allow only if within 35,000 per person per day. Yes, to be very careful about the fact that income tax says, my dear child, bearer check and cross check is not a permitted mode of transaction. You cannot take that into consideration. It is fully to be disallowed. That is the provision for you. Any doubts on this part? Yes, so be extremely careful on these conditions, people. Be very, very mindful that a bearer check and cross check is also not considered as a permitted mode and will trigger 43 conditions, which means if it was not a transport operator, I would have restricted to 10,000. But because it is transport operator, I'm restricting to 35,000. And that's what the provisions are. Clear with me on this? Yes, be very, very careful on this adjustment of. Good to go. Good. We are moving to question number 29, adjustment number 29, people. Adjustment number 29 basically says they want to know what is the MSME payment rules and the interest on MSME conditions. Let's answer it one by one. First, let me talk about the interest on MSME. Income tax says any interest on MSME, any interest is fully disallowed. Any MSME is fully disallowed. Income tax is basically come and said, my dear child, when it is a payment of interest, I don't care. Interest paid to micro, small, medium, does not matter. Every single thing is disallowed, and that's what the condition is. But when it comes to payment, answer is only for micro and small. It is only for micro and small. Medium is not covered. Be very careful. When the interest is talked about for all people. Micro, small, medium, all are covered, but payment is only for micro and small. Here where income tax comes and says, if it is written, it is pay within 45 days or promised date. It is pay within 45 days or promised date, whichever is earlier. It is whichever is earlier. Let me make it easier so that you understand the short forms. It is whichever is earlier. Yes, if it is not a written agreement, if it is oral agreement, then it says pay within 15 days. It is pay within 15 days, and that's what the condition is. So be very, very careful on the fact, people, that when it comes to payments only micro and small is covered. Medium is not covered. Medium is not covered when it comes to payment. Matlab, in medium cases, even if I make the payment late, income tax is going to say, no problem, my child, it's completely fine, take it off, it's not a problem. But when it comes to interest says it is all covered. Matlab, MSME, every party is covered, everyone should be taken into consideration. But the rules are, when it comes to payment, 15 days or 45 days or promised date, whichever is earlier, and oral it is within 15 days. Some things to be kept in mind. It is allowed, you can say, if late, allow in the year of payment. Yes, it's not a permanent disallowance, it's a temporary disallowance. Income tax says whenever you've made the delay, you can claim it in the year of payment, which is why you have to be careful. There are sometimes a question which comes in exam, people. The question examination comes and says, I have made a promise in March. Not March, let's say January. I've made a promise in January. I have made the payment in March. Now, logically, if you think a promise of January, matlab you should have paid the payment somewhere within 45 days, which will be mid of February. So technically, in the mid of February, this payment became late, no doubts. But because you've made the payment in March, what happened? In the month of February, when the payment was delayed, you disallowed it. But in the month of March, when the payment was made, you have to allow it as deduction, which means in the same year, there is a disallowance. In the same year, there is an allowance. Net impact is zero. Yes, so you have to be very smart enough to understand that when it comes to this conversation, if you have disallowed it in the same year and allowed it in the same year, the net impact is zero and therefore there is nothing to be worried about. The problem comes only in one scenario. The problem comes in one scenario where you come and say that the promise has happened in the current year, the sale has happened in the current year, the payment is happening in the next year. That is when this conversation comes into picture. So this conversation is only applicable when the payment and sale is happening in two different financial years. Whereas when it comes to interest is anyway fully disallowed, nothing has to be worried about, and this is what the conditions are. Clear with me on the conditions? Yes, very good. Next comes your adjustment number 30, one of the most trickiest adjustments which comes in examination because students don't pay proper attention to it. Adjustment number 30 says computer which is purchased for 80,000 is debited to P&L account. First line item is an issue. Question says I have debited 80,000 rupees worth of computer to my P&L. 25,000 rupees was paid by cash on a single day. And here is where the problem starts. People start realizing the fact that yes, cash has been made more than 10,000 and therefore should be disallowed. I agree. I'm not denying that. But be understanding first. First of all, question is very simple. People, why on earth is a computer debited to P&L account? Doesn't computer look like an asset to you? If an computer looks like an asset, how on earth is it there in the P&L? Something is wrong about the accounting itself, which means even before you jump to the fact that 10,000 was paid by cash, jump to the fact to understand that asset itself is debited to P&L, which itself is a wrong entry, which means the mistake if students are doing saying 25,000 should be disallowed is wrong. The answer is you should disallow the complete 80,000 rupees first. That is the answer. So the answer is disallow full 80,000 rupees. Disallow full 80,000 rupees since it is a capital expenditure. Disallow full 80,000 rupees since it's a capital expenditure. Now, you may come and ask, Rahul, if you're going to disallow the whole 80,000, what is the relevance of 25,000? The relevance of 25,000 comes in depreciation topic. If you remember depreciation topic, people, depreciation topic also has the same rules. The rules come and say, when you make an asset purchase more than 10,000 rupees, the excess payment which you're going to make is not going to be considered an asset itself. Which means the moment I made a 25,000 rupees worth of cash, income tax will say the asset itself is not worth the 25,000. I am going to ignore the quantum of 25,000 for depreciation purposes. Which means here what's going to happen is I am going to first disallow 80,000 worth of asset in my capital expenditure module. And then I am going to claim depreciation. I am going to claim depreciation only on what, people? I cannot claim depreciation on 25,000 rupees because that has been paid in cash. Matlab, remove the 25,000 rupees and I can only claim depreciation on rupees 55,000. That's the conversation answer. That's the conversation answer. Are we clear on this part? This is the understanding, people, which you have to have in examinations. Basic accounting understanding will make you go a long way. Yes. So don't mug up the facts that yes, 10,000 Kamala payment is to be disallowed. Before that, first realize computer itself is a problem. Having a computer in my P&L is a wrong adjustment. It should not have been taken itself. That is the understanding which you should keep in mind. Yes. So I hope you're able to get this logics, people, because these are all adjustments which has come in examination and you have to be careful on how to read these things. Clear enough to go? Any doubts, my friends? This is what the logic is. Yes. Perfect. With this, we are just 20 more away. So stick with me. We're going to complete this off very, very smoothly enough. Let's go together. Yes. I'm at adjustment number 31. Adjustment number 31 says penalty which is paid to government for delay in completing highway projects. Now, here, two things to be kept in mind. One, you're seeing a penalty coming in. And the moment you see penalty, the first thing you'll jump and say, penalty, Rahul, disallow, penalty, disallow, penalty, disallow. No. People, no. Understand this carefully. Penalty is only disallowable if it is for a violation of a law. There is no law here. It says, yes, I'm making a penalty. Yes, the penalty is being made to government. But the fact is, it is for a delay in completing a highway project. Delay in completing a highway project is not a law offense. Yes, you can only disallow a penalty when it is a penalty for an offense of law. Since there is no offense of a law here, this is allowed. This is allowed. Nothing can be done. This is the adjustment. This is the final answer for you to keep in mind. Any doubts on this part, my friends? Yes, to be extremely careful on how this adjustment looks like. This is where you have to be extremely careful on how you read things. Reading penalty is not bad. Reading penalty, why is the question mark, which you have to answer in the examinations. Clear? Yes, that is what the understanding should be. Clear to go? Perfect. With this, people, PGBP is out of the way. We are now moving on to capital gains. Now, capital gains, like, technically, if I have to put out in the super 50 adjustments, I would have to put out the immovable property related things, because that's the tricky one. But I have already prepared a video for you on the immovable property part. And so therefore, if you go to my channel, you'll find something called capital gains on immovable property decoded. It's already available, people. So if you're able to do the immovable property decoding from there, I do not have to put it here. So I have not put it here. You can take it from there. I think that should solve the job for you. Yes, so now we are pending on the next things, the smaller things of capital gains, which is important and tricky enough. The first thing is saying capital gains cost of acquisition is requested in case of listed equity shares, which is purchased before 1st February 2018. When you purchase an asset before 1st February 2018 as listed equity shares, the provisions of section 112A applies. And for those who remember, people, when it comes to 112A, 112A has a rule. If you bought the asset before 2018, there is a certain problem. Income tax says when you have bought an asset for 2018, Kamunadi, cost of acquisition for the purpose of section 112A is going to be the FMB as on 31st January 2018 versus full value of consideration, the actual full value of consideration, whichever is lower. This is going to be compared with the actual cost of acquisition, whichever is higher, and this is how you compute the cost of acquisition when an asset is purchased before 2018. If you're purchasing an asset before 2018, this is the formula which you have to follow. Please make sure to follow the formula properly. And notice very carefully, what is being discussed here is only the cost of acquisition. I have not discussed what is the profit here. I've only discussed what is the cost of acquisition, meaning you will have to take the sale value, reduce this revised cost in order to arrive at the capital gains for yourself. That is what the understanding is. Clear with me on the understanding? Any doubts on this part? Yes, good. Next one, people, the most important thing which I remember and believe that should be tested in examinations, because your May, September and Jan is the last attempt where buyback can be tested. The rules of buyback for this attempts alone basically comes and says, whenever you have any buyback in the company, whatever is the buyback price, is taxable as IFOS. Whatever is the buyback price, income tax is whatever money you're going to get from the company, straightforward tax it as IFOS. Whatever is the cost of acquisition for the shares. Yes, obviously, no, people, when a shares has been bought back, what would have happened? You would have first paid money from your pocket, then the company would have given you buyback money. Yes, so whatever cost of acquisition you have for the shares is directly treated as a capital loss. Is directly treated as a capital loss. This is what the answer is, which means you will get a question in exam. The question will probably come and say that my cost of acquisition is 4 lakhs. The buyback which has happened as 6 lakhs rupees. You're simply going to say 6 lakh rupees take to IFOS, 4 lakh rupees treated as capital loss. And that's what the answer is. Yes. Now you may come and say, Rahul, Anga 6 lakhs here, 4 lakhs. What is the difference? Difference is very important. IFOS is a slab income. Capital gains is a special income. Can you set off your long-term capital loss against IFOS income? No. Can you set off your short-term capital loss against IFOS income? No. Which means technically what's going to happen, the 6 lakhs is going to become taxable nevertheless. The 4 lakhs is only going to be allowed as set off if you have other capital gains in your question. If not, then that's going to get carried forward. And that's the unfortunate reason of buyback. So be very, very careful about this. You can expect a question as a 1 mark adjustment in examination in your compulsory question as well. Be extra smart on when you read these kind of questions. Clear? Yes. Perfect. Let's move on forward. We are moving on to IFOS, adjustment number 34. Adjustment number 34 says land has been purchased for 30 lakh rupees in 2005. First thing to be kept in mind is that land purchase in 2005 becomes a cost of acquisition. Yes. Next, gifted in 2025 when the stamp duty value is 90 lakh rupees. Matlab, I have gifted it. My consideration value is 0. My consideration value is 0. Yes or no? Yes. Now income tax has come and confirmed to you that you have sold the asset at 0 price when the stamp duty value is 90 lakhs. Question is saying, give me the implications of buyer and seller if the buyer and seller are related. What is going to happen if the buyer and seller are related? First things, people, let's look from each perspective. From a buyer's perspective, what has happened? From a buyer's perspective, the buyer has given the house as a gift And that's where the problem starts. Capital gains come and say that when a buyer is giving a gift, the person who's holding the asset gives a gift to someone else, this transaction is not regarded as transfer. This transaction is not regarded as transfer. Yes. So from a buyer perspective, I'm going to make my life easier. Buyer is going to say it is not a capital gains. Buyer is going to say it is not capital gains. I don't care whether you're related to me or not related to me. At the end of the day, I've given a gift to you. Gift matlab it is not taxable as transfer, and that's what the answer will say. The problem comes on the seller side. The problem comes on the seller side. Now, as a seller, I will start asking questions. People, seller matlab, I'm sorry, this is ulta. Sorry. People, first thing is the seller. Seller is the one who's going under capital gains, right? Yes. So seller is going to say, I'm going to sell the property, but I've sold it as a gift. Capital gains will say, when you give a gift to another party, this is not regarded as transfer, and that's when the provisions will hit. Problem comes on the buyer side. Now, as the buyer, you have received a house for free when you should have paid 90 lakh rupees for it, which means you have technically received a gift. IFOS rules are going to come into picture. Now, when IFOS rules are going to come into picture, we have discussed it in class, people. There is a 3-step process on IFOS. Step number 1 is to identify the asset. And we know land is a covered asset. Second, we discuss about the fact that you have to check for any exceptional rules. And exceptional rules come and say that if you're going to get any kind of gift from a related party, then that is not taxable as gift. Which means in the first conversation, when you said that the buyer and seller are related, I'm going to say not gift under IFOS. I'm going to say not taxable in IFOS because the buyer is related. There is nothing which we can do. So therefore, it is not going to be taxable in IFOS. The matter closes there itself. But here is the problem. Now, people, I'm the new buyer. As the new buyer, I have received a gift for free. My cost of acquisition is technically zero because I never paid anything for it. And IFO is also not taxed it. At this stage, capital gains has a different rule. Capital gains come and says that when I have sold an land for free, meaning I have not received capital gains on it, buyer has also not paid tax on it in capital gains, then in that case, what will happen? Cost of acquisition for the seller will become, cost of acquisition for the new owner will become cost of previous owner. Yes, once again, people, what is happening? Income tax is saying when I have not taxed anything under IFOS and capital gains, like you have also not taxed it, then the cost of acquisition of the new owner will become cost of previous owner, which means in this conversation, I'm going to say cost of acquisition is going to become the previous owner's cost, which is 30 lakh rupees, and that's what the answer will be. Clear, not clear? Very good. Now comes the next part. The next part is where they say the buyer is unrelated. Now, when the buyer is unrelated, same logics will apply. As the buyer, I am coming and saying I have received a gift. Now, income tax will say 3 conditions. Condition number 1, check for the asset. Yes, land covered. Condition number 2, check for exemptions. Do I have any exemptions? No, not related party. Condition number 3, check for the limit. Now, I have a limit of 50,000 rupees, which has anyway been breached. With all that conditions getting satisfied, the buyer will now have to pay tax under IFOS. Yes or no? So, I am going to say taxable of how much is the IFOS gift is the question. People, how much should I have paid? 90 lakhs. How much did I pay? Nothing. When I've paid nothing, I'm going to say taxable of rupees 90 lakhs in IFOS. Yes, the whole 90 lakhs will become taxable under IFOS because at the end of the day, what happened? I should have paid 90 lakh rupees for this property, but I paid nothing for the property. So it became 90 lakh rupees worth of taxable gift. Now comes the important part. People, now I am the buyer. I have already paid 90 lakhs to the government as IFOS gift. At this point, I have 2 choices. Choice number 1, I will say, sir, I have already paid 90 lakhs to you. So technically, it's like I have purchased this land from you. So my cost is 90 lakhs. Choice number 2, you can say, sir, buyer has told me, no, that buyer has given a gift. So whatever his cost, I will take, which is 30 lakhs. If you're a smart assessee, why would you choose 30 lakhs? You've anyway paid tax on 90 lakhs. So you will say, sir, let's the 90 lakhs get lost. I don't care about the 90 lakhs. I am focused on the, let the 30 lakhs get lost. I am not bothered about 30 lakhs. I am focused on the 90 lakhs. And therefore, cost of acquisition in this case will become 90 lakh rupees because I have already paid tax on this in the previous case. Yes, so this is one adjustment which I've told in the class many times and students have got confused on it. Be careful about it. The fact is very simple. Income tax will say when a seller is giving a gift, it is not taxable in CG. Matter is over. When the buyer is collecting it, buyer will decide whether he has to pay IFOS tax or not. If he does not have to pay IFOS tax, I will say buyer, seller both are not paying tax. Cost of the new owner will become cost of the previous owner. But if you come and tell, no, the new person has to pay tax under IFOS, he will say, then why the earth should I take the original cost? I'm not going to take the original cost itself. Let me take the new cost itself. New cost is 90 because that is what I bought from the government now. Yes, I may have not bought it from the seller, but I did buy it from the government for 90 lakhs. So I would like the cost to be 90 lakhs. Please give it to me as it is. Don't object me here. That is what the conversation will look like. Clear with me on this background? Yes, to be extremely careful and smart on how you read this question, and that is where the answer will change for you significantly. Clear? Be very smart in this conversation, people. Are we ready to go? Perfect. I'm at adjustment number 35. From here, I think things should become simple. So let's look at this very, very quickly. First, it says loans are given to shareholder holding 18% of 3 lakh rupees and the accumulated profit is 2 lakhs. One adjustment which students generally don't tend to do anything in examination, because the first thing they look at is they say, Rahul, loan has been given to you. This is money which you have to repay. Yes, so why are you bothered about it? No. We have a special provision in income tax, a provision called section 222E. If you remember this provision, people, section 222E comes and says that any shareholder holding more than 10%, should not receive any loans and advances from its company. If you are going to receive any loans and advances from the company, whatever loans and advances you received from the company will be taxable as deemed dividend to the extent of accumulated profits. I'm repeating myself once again. Any shareholder receiving more than 10% holding, if they receive any loans and advance from the company, then whatever money they receive will be taxable as deemed dividend to the extent of company's accumulated profit. In this case, my shareholding has crossed 10%. I have received 3 lakh rupees where the accumulated profit is 2 lakhs. Income tax will say, beta, if the profit itself is 2 lakhs, you can only tax 2 lakhs. And therefore, I will say dividend taxable is equal to rupees 2 lakhs. Dividend taxable is equal to rupees 2 lakhs. This is what you have to pay tax on. Now, this is something which students generally tend to not remember itself in exam, because be very careful. I do not have any provisions relating, provisions relating to loan are impactful in exam. Just because you see a loan and you say it is not taxable is not the right answer. Loan is also taxable if it is given to a shareholder holding more than 10%. Be very careful about this conversation. Clear? Yes, so be extremely careful on this reading and make sure that you tax the 2 lakh rupees if you see a loan in the examination saying that you have received loan from a shareholder. Clear? Yes, perfect. That brings me to the last few items. 36 people. 36 says dividends received is 1 lakh rupee, interest on loan paid is 35,000, commission paid is 5,000 rupees. This is what it is, and the question is basically coming and asking, tell me what is a taxable dividend. Yes, taxable dividend in this case is going to be a little simpler, so be very careful on this. Things which you have to keep in mind. Income tax has come and confirmed that when it comes to dividends, no expenses can be claimed as deduction except for interest on loan. Interest on loan is the only deduction that you can claim in dividends. You cannot claim any other deductions, which means first things I'm going to say, sorry, not allowable. 5,000 has been removed, cannot be claimed as deduction itself, not going to be granted to you. Coming to the interest part also, income tax says maximum you can claim interest deduction is 20% of the dividend income. You cannot claim an interest deduction more than 20% of dividend income. So you have to restrict it to 20% of dividend income is the condition given to you, which means in this conversation, I'm going to say taxable dividend is going to be 1 lakh rupees, which I received, minus only 20,000 rupees, which I can claim. Minus only 20,000 rupees, which I can claim because the restriction is maximum 20%. The restriction is maximum 20%, giving me the taxable amount as 80,000 rupees, and that's how the answer will look like. Yes, so be extremely careful on this conversation to make sure that you get the right answers. Clear? Yes, beautiful. This is what your heads of income were, people, and this is how you have completed 36 adjustments out of 50. I hope the pace is going on well and you're able to get the right answers here. Yes. Perfect. That leaves me with a set of questions from the smaller ones, people. Let's see if you're able to get these right questions. I am at question number 37. Question number 37, adjustment number 37 of clubbing rules. This is one I personally designed myself for a trick adjustment of you. So let's see if you're able to get this right answer. Adjustment says, partner has received the following payments from a concern in which the spouse also has 19% PSR. There is a concern in which me and my spouse both have partnership ratio. I have some ratio, wife has some ratio, spouse is showing 19%. That is what the conditions are. With that, they are coming and saying the following payments have been received by you. Payment number 1, I have received share of profits. As a partner, if I have received share of profits, people, I'm sure you should have got this right answer. The answer is fully exempt. Yes, income tax has made it extremely clear that any share of profit received by the partner is going to be fully exempt from tax, has nothing to do with income tax, will not pay a single rupee tax on it. Be very careful. Yes. Second, it says interest on capital, where capital investment was from spouse money, meaning spouse gave me money, I put it in the capital of the company, and I have now received interest on capital. Number is 15%. Amount I've received is 1,50,000. Two things are triggered here. One, you need to realize that the money was given by spouse, and therefore income tax says where any money is given by spouse, whatever income is generated from that money will be taxable in the hands of the respective person. And therefore, even though I received interest on capital, this will be taxable for the spouse. But here is the trick. Here is a trick which if you did not realize is going to cause you problems, is that income tax comes and says when it comes to partners, a partner is not going to be taxable for any interest more than 12%, because a firm itself could have claimed only 12% worth of interest. If you remember the partnership rules, people, partnership rules come and say that you cannot have a partnership, a partner receiving interest on capital more than 12%. If a partner receives more than 12% interest on capital, the firm will pay tax on it because the firm is going to disallow the expense, which means here I will not give you a full taxability of 1,50,000. Income tax will say first compute the interest, and therefore I'm going to say interest of what is the 12% people. If 15% is 1,50,000, obviously 12% is 1,20,000. Yes, I'm going to say interest of rupees 1,20,000, which is nothing but the 12% is taxable for me as spousa. Is taxable for me as spousa. It is taxable for spouse. It is taxable for spouse. That is what the conversation is. Clear? Yes. Keep that in mind. Third one is the most adjustment one, people, the beautiful adjustment which I've prepared for you. Look very carefully. It says salary received is 3 lakh rupees with no technical qualifications. Now there is a provision under clubbing provisions come and say when you have any salary received by the spouse where the person does not have technical qualification, then in that case the spouse, the remuneration will be taxable in the hands of the other spouse. Which means here is a case where I have received salary of 3 lakh rupees with no technical qualifications. Normally this should be clubbed in the hands of the spouse. But that is where the problem came. The problem came to the fact that you have only 19% PSR. The problem is income tax comes and says that provision only applies when there is substantial interest, which means the other spouse should have substantial interest in the concern. Here there is no substantial interest. Here there is no substantial interest, which means despite the fact that I do not have any qualification, my spouse having no substantial interest in the concern means that it cannot be clubbed in her hands. Matlab it is still taxable in my hands, and therefore income tax will say this is taxable for the partner. This is taxable for the partner. But here is the question, people, at this stage, if you have mugged up clubbing properly, you would have got the right answer. You would have made a horrible mistake, because in clubbing we have done one thing. We have always come and told Rahul, the moment you see the word salaries, give 50,000 deduction, give 75,000 deduction, because you are salaries, head of salaries, 50, 75. No. Notice one thing very carefully. This is payment received as a partner. Partner payments of salaries are not taxable under salaries are taxable under PGBP. Yes, so here it is taxable for partner as PGBP income. Here it is taxable for partner as PGBP income, and because it is taxable to the partner as PGBP income, will you grant any standard deduction? No. You cannot grant any standard deduction because there is nothing to be reduced of. You can only grant the standard deduction if it is taxable under the head salaries. There is no standard deduction in this because I am going to tax it under the head PGBP. So yes, please be careful. The fact that it's a partner salary was never taxable under salaries. It went to PGBP. So there was never a concept of standard deduction. It had to be taxed in the hands of the partner under the head PGBP. Yes. Now, even in a case where the spouse would have had substantial interest, even in that case, I would have taken this and moved it to spouse under the head PGBP only, because clubbing comes and says it has to be in the same head as what I would have taxed it, because my partner would have taxed it under PGBP. Spouse would also end up taxing it under PGBP. Matlab standard deduction would have never been granted. Please be extremely careful on this conversation. Are we clear on this adjustment, people? Be very, very smart and careful on this adjustment. One of the beautiful questions which has been designed for you to keep in mind. Yes, yes, good. With that, people, we're moving on forward. Question number 38 says, income of 7 lakh rupees of minor child, which has come from winning singing show, which means minor child has received money for winning a singing show. Received 48,000 from father's friend as gift for winning show. Matlab father's friend has given a gift because you have won the winning show. Invested all the money in FD and have earned 15,000 rupees. This is the conversation, and here is where you're going to make mistakes. First, one by one, people, let's understand the rules of clubbing. Minor child clubbing rules come and say any income which is received by the minor child will be taxable for the parent whose income is higher. That is rule number one. Yes, the first things to be kept in mind that it is taxable for the parent whose income is higher, but 3 reasons it will not be taxable for the parent but for the child itself. Reason number 1, if it has come from any kind of manual skill, labor and talent. Reason number 2, if it has come from any kind of disability of the child. That is what the 2 things. And third is if it is any, so we have written it, yes. So it is manual labor, it is skill and talent, and if it is any kind of disability of the child. In this case, you have to play this carefully. Matlab, we are going to look at each item one by one. First, I'm going to say the number of rupees 7 lakhs. The number of rupees 7 lakhs logically should have been taxable for the parent. But here, I am telling that the money is coming from singing show. And singing show is a skill and talent, and therefore this is taxable for the child itself. This is taxable for the child itself because it is coming out of talent. Correct, not correct? Great. Next comes the question on 48,000. Next comes a question on 48,000. Tell me, people, father's friend giving a gift to you for singing show. Is there any skill or talent involved? Is there any manual labor involved? Is there any kind of disability with you? No. And therefore, in this conversation, you should normally come and say this is taxable for parent. I agree. I agree, perfectly agree. Problem came when you did not notice the number. People, when it comes to gift, I've always told you, never jump on the gift rules. Gift has a 3-way condition and you have to follow the 3 conditions properly. Condition number 1, I should have received an asset which is covered. This is money covered. Condition number 2, it should not be an exception rule. Father's friend is not an exception, which means definitely taxable. But condition number 3 is what you missed. Condition number 3 comes and says, I should receive a gift more than 50,000 for it to be taxable. Notice, I am only received 48,000 worth of gift. Yes, with a gift of rupees 48,000, the IFOS rules itself have not applied, which means this answer says it is not taxable for anyone. It is not taxable for anyone as the gift is less than 50,000 rupees. As the gift is less than 50,000 rupees. Yes, so this is one small thing which you have to keep in mind, people, and I'm hoping you have done this properly. Final answer is your 15,000 rupees. Now 15,000 rupees is where you have to keep in mind. Some students have this impression in mind saying that, Rahul, if the 15,000 rupees is coming from the singing shows of 7 lakh rupees, why should it be taxable for the parent? Let it be taxable for the child because it's an ancillary income. No, income tax has made it extremely clear that beta, any income is for the parent except for 3 reasons. Now, when the child put the money in FD and got 15,000, there was no skill involved, there was no talent involved, there was no manual labor involved, and neither was the child disabled, which means this has to be taxable for the parent, and therefore I will have to move it to the parent. So the answer is this is taxable for the parent. This is taxable for the parent, and that's what you have to keep in mind. Yes, so this is an adjustment where you have small things which is to be kept in mind. People, be very careful on this conditions of. Clear? Yes, good. With that understanding, people, I'm moving on forward. Question says 39 says I have HP given by mother for inadequate consideration. Mother is going to give HP for inadequate consideration. Rent receivable is 40,000 rupees per month. Implication if father has a higher income and receiver is a minor child. Look very carefully. Income tax says what is happening. I am telling you there is a mother. Mother is giving the house to the child, minor child, where the father is having higher income. Now here is where students end up getting confused. First things is that they realize the word minor child, and the first question which comes is, okay, minor child income taxable for parent whose income is higher, which means father is the one having a higher income. Let's tax it for the father. No. That's the mistake you made. People, when it comes to these kind of rules, one thing to be kept in mind is there is also a separate chapter called deemed ownership. HP chapter has something called deemed ownership, and deemed ownership comes and says whenever there is any transfer happening from spouse, from parent to the minor child, it is taxable as deemed owner for the respective parent. Their deemed ownership mein we do not have the condition of parent whose income is higher. Matlab, in this conversation, when the house was given by the minor child, when the house was given by the minor child rules will now part of deemed ownership, and therefore I will say deemed ownership conditions apply. I will say deemed ownership conditions will apply. Tax for mother. Here, even though father's income is higher, I will say no, I'm going to tax it for mother, and that's what the rules are. The next part is the most critical one. People, because you have taxed it in the hands of mother based on deemed ownership and not based on clubbing rules, you cannot claim the deduction of 1500. You cannot claim the deduction of 1500 because 1500 ka exemption is only granted to you if you are taxing it as per clubbing rules. Now, I have never taxed it under clubbing rules. I have taxed it as per HP rules, and therefore this will not be covered in that conditions of. Clear? Next part says I am going to have what is called as minor married daughter. Now, if you remember the HP rules, people, HP says any kind of transfer happening from parent to minor child will be taxable for the respective parent. However, this provision does not cover minor married daughters. Minor married daughters are not covered in it because it is covered under clubbing rules, and therefore here I will apply the clubbing rules. Now, because I am applying the clubbing rules will say tax it for the father because his income is higher. Tax it for the father because his income is higher. And will you grant standard deduction? Yes, 1500 ka exemption is available to you under DTR. 1500 ka exemption is available to you under DTR. So yes, this has happened in exams multiple times, people, where ICI has tried to trick you with this adjustment. Notice one thing carefully: any kind of house transfer from spouse to another spouse, any kind of house transfer from a parent to a minor child is covered under deemed ownership conditions and not under clubbing rules. When it is covered under deemed ownership conditions, you cannot apply the exemption of 1500, and you cannot apply the fact that parents which income is higher should be taxed. You have to apply the deemed ownership conditions, and deemed ownership condition says it is taxable for that parent who gave the house. So very important, very careful adjustment. If you're going to have a clubbing and set off question, I really do hope that these kind of adjustments come and does trick you enough. If you have done it right now properly, I'm sure you're going to get this right in the examination as well. Yes, that's the whole idea about Super 50 adjustments, people. I'm trying to give you all the toughest of the adjustments so that you're able to get the right answer in examination. Now, if you knew this exemption even before I wrote this, amazing job, I'll tell you. Seriously, amazing job, because this is linking multiple chapters and you're getting it right. Perfectly done well. Yes, perfect. With that understanding, people, I'm moving on forward. The last 10 adjustments for me to cover off. Whew, 2 hours we're done. Yes, let's look into the last 10 adjustments. Strong force, people. Let's work it out. Okay, come on. Yes, so 10 adjustments for us to complete off. I'm in losses chapter. Losses come and says any kind of losses from futures and options is 45,000. Income coming from furniture business is 50,000 rupees. The question which came in exam somewhere around September attempt of 2024 was when the ICI suddenly gave you a question which said futures and options, students started getting confused. Students didn't realize what is F&O because at inter-syllabus you don't know these kind of things. But yes, students made a wild assumption saying futures and options look like speculative loss, and speculative loss cannot be set off against any other income other than speculative income. So they said no set off is permitted, but no. Income tax does give you a clarification that speculative business only means intraday trading. Any kind of intraday trading alone is called a speculative business. Derivative contracts are not speculative, which means this is not a speculative business. This is not a speculative business. Income tax considers this as a normal business activity, which means set off is allowed. Set off is allowed, and that's how the conversation looks like. Yes, so be extremely careful on this discussion of. Any doubts, my friends? Clear? Perfect. Then question is, people, can you allow set off in the following case? Question is, can you allow speculative loss against PGBP profit? Can a speculative loss be set off against PGBP profit is the question. And the answer is a simple, straightforward no. You cannot set off any speculative loss against PGBP profit because speculative loss can only be set off against speculative profit, which means the answer here is no. But can you set off PGBP loss against speculative profit is the question, and the simple straightforward answer is yes. I remember telling this in class also, people, and I want you to understand this. Every time you read a question from losses perspective, always look from the loss perspective. Never look at it from a profit perspective, because you will end up making mistakes. If you come and tell me, Rahul, speculative with diya, if speculative profit is given, why are you setting off? Problem is never on the profit side. Problem is always on the loss side, and loss of PGBP comes and says a PGBP loss can be set off against anything except salaries. And when I say anything, I mean speculative as well, which means it will be set off against speculative profit no matter what. Clear? Yes, to be extremely careful on this understanding, people, please make sure to get this right. Notice that you have to always look from a loss perspective. In the first conversation, it was speculative loss, and therefore I had a problem against speculative profit and PGBP profit. But when it is PGBP loss, I have no restriction other than salaries, and therefore speculative profit will get a set off. Clear with me on this? Be very, very careful on this understanding of. Clear? Yes, perfect. Moving on, people, we're moving on to chapter 6A, adjustment number 42. Adjustment number 42 basically says, I want to know what is the NPS contribution rules when it comes to employer and employee. They want to understand what are the rules of NPS when it comes to employer and employee. Now, this is scattered into multiple chapters, so let's get it right. First, let's look at it. What happens in the books of employer? What happens in the books of employer? This is the first question you're going to ask. Yes, now people, for doing this, you have to first understand where are you standing. I am an employer. Employer is going to give NPS. Matlab, for an employer, it is an expense. An expense only sits in one head of income, which is PGBP. Yes, now if you read PGBP properly, PGBP, there is one rule, people. The rule comes and says, when an employer is giving contribution to NPS for employee, he should not give a contribution more than 14%. No contribution more than 14% should be given. Any contribution which he gives more than 14% will be disallowed. Yes, so the rules of employer is that I will disallow under PGBP. I will disallow under PGBP if paid more than 14% of employee salary. Yes, this is first thing to be kept in mind from an employer perspective, which means I am an employer. For me, it's a payment. Payment is what is discussed under PGBP rules, not under any other rules. So be very smart on that. Yes, now coming to the fact on employees, which means I am now going to ask what is going to happen in the books of employee. In the books of employee, what is going to happen? People, if I'm an employee, I'm going to receive NPS. And when I'm going to receive NPS, technically it is going to be taxable under salaries. Yes or no? Yes. To understand the conversation very carefully, when it comes to employees, there are multiple things which are going to happen. First, as an employee, I will come and ask, what kind of contribution are you talking about? What kind of contribution are you talking about? Are you talking about the employer contribution, or are you talking about the employee contribution? Matlab, am I talking about the employer contribution, or am I talking about the self contribution? Let me put it this way. Yes, so I'm asking a very simple question. Am I talking about the employer contribution, or am I talking about the employee's contribution? Income tax says, boss, if you're going to talk about the employer contribution, in simple words, what has happened? Employer has come and said, employer is going to put money into NPS account. If the employer is putting money into NPS account, then who is he putting it for? He's putting it for the employee. If he's putting it for the employee, technically, first thing you need to understand, people, why would employer pay money for employee unless it is taxable for him? And therefore, for the employee, it is first taxable under the head salaries. It is first taxable under salaries. Yes or no? Yes. So be very, very careful on this conversation to understand what is happening. Clear enough, my friends? Yes, I am where I am in employees books. In employees books, I'm talking about employer contribution. In employees books for employer contribution, the rule is very simple. You will tax it under the head salaries. Next, what will happen? You will come and say claim chapter 6A deduction. Claim chapter 6 reduction, or if you understand, we call it ATCCD. Yes, so claim chapter 6 reduction, how much? It is 10% under ATR and 14% under DTR. Correct? If you remember the provisions, people, this is what the provisions were. The provisions were simply used to come and say that when it comes to employer contribution, whatever money employer is going to give, that will first be taxable under the head salaries for him. After taxing it under the head salaries, I will simply come and ask, what are you going to do? Because it is taxed under salaries, you can now claim it as deduction under chapter 6A. 10% will be allowed under ATR and 14 will be allowed under DTR, and that's what the conversation was. Yes. Next, I am coming and saying, no, Rahul, this is employees contribution. If it is employees contribution, then income tax is coming and telling, beta, you are putting your own money, right? If you're going to put your own money, how will this work out? I'm going to simply come and say, if you're going to put your own money, the first 50,000 is allowed without any restriction. The first 50,000 is allowed without any restriction. For the balance, I will allow up to 10% of the salary. Yes, so income tax is saying whatever contribution you've made, you can allow first 50,000, no restriction, whatsoever is fine. But the balance, whatever you're going to pay, you can allow it up to 10% of salary, subject to section 80 EE, subject to section 80 CCE. Yes, subject to section 80 CCE. Now, if you remember 80 CCE people, 80 CCE basically comes and says that when you want to claim this balance amount, that has to be incognizant along with your 80C and triple C. Matlab it is subject to an overall restriction of 1,50,000 rupees. Yes, so it is subject to 1,50,000. Let me put 1,50,000 itself. You will understand this better. Yes, so income tax comes and says this 1,50,000 along with 80C, along with 80 triple C has to be taken into mind. So you will say for the balance, you will allow up to 10% of salary, maximum of 1,50,000 under 80C, 80 triple C, 80 CCD. That is what the conditions are. Yes, by the way people, these provisions are only covered under ATR. Matlab DTR mein no such benefit. So this benefit is not given under DTR. How do I put this to you? Let me try. I'm going to put this whole thing in a circle. No. Let's do this. Not very clear. I am going to increase the opacity. No. Yeah. Perfect. Yes. So I'm going to take this into consideration and I'm going to say only under ATR. Only in ATR, and that's what the conditions are. Clear with me on this? Yes. So please be very careful people when it comes to employees contribution. Income tax is saying employees contribution ke liye to rules are only under ATR. You don't have a rule under DTR itself because DTR mein I'm not giving this benefit itself. In employer contribution, since you have taxed it under salaries, I have no other option but to give you that benefit, and therefore income tax says take the benefit of. In fact, you can take the benefit in such a way that in employer contribution 14% will be allowed under DTR if you choose DTR scheme, whereas if you choose ATR scheme, then I'm going to allow only 10% to you. So that is what the benefit is. So yes, employer contribution gets enormous amount of benefits under DTR scheme if you choose for employer contribution. But this is one area to be tested very, very carefully. So be very, very smart on this. Clear? Perfect. This moves me on to 43. 43 comes and says, what is the rules for preventive health checkup? Preventive health checkup is very simple. The rules says you can claim a maximum 5,000 rupees for all. Yes, this is one adjustment which comes in exam almost every time people, where what happens is ICI will come and tell you that for self, spouse and dependent children, in my bucket I would have paid 4,000 rupees and in parents bucket I would have paid another 4,000 rupees. Now you have to realize that I can overall itself claim only 5,000 rupees for all people included. Me, my spouse, my dependent children, my parents, everyone gets a together bucket of 5,000 rupees, which means someone will have to take a chance. If you are giving full 4,000 rupees for yourself, the parents are only going to get 1,000 rupees. If you're going to claim 3, parents get 2. If your parents are going to claim 5, then you are claiming nothing. That's how it is. So it is maximum 5,000 rupees for all and allowed in cash. Yes, in 80D, the rule is that everything should be paid in non-cash items except for preventive health checkup. Preventive health checkup can be paid in cash. That's what the conditions are. Yes, second one, it says medical expenses which are incurred by senior citizen parent is 40,000. First things I am noticing, there is a senior citizen. Matlab parent is a senior citizen. Bucket has enhanced to 50,000 rupees. Next, medical insurance paid premium for the said parent is 35,000 rupees. Now here is where students get confused. They know that there is an overall bucket limit of 50,000 rupees. So what they'll do, they'll take the 40, they'll take the 35, 75 becomes 50. No, 0 marks. Same parent, notice, the same parent has incurred medical expense, the same parent has incurred medical insurance. And if you remember the rules carefully, people, the rules come and say that for one parent who does not have medical insurance can claim his medical expense for a limit of 50,000, which means it is not if and or, it is not and condition, it is only one. If you have insurance, insurance is the answer. If you don't have insurance, then you can claim medical expenses. Notice this question. Same parent, I have a medical insurance. Same parent, I've incurred medical expenses. You cannot claim the expense at all. You cannot claim the expense at all. The answer is rupees 35,000 is allowable. Rupees 35,000 is allowable. No expense when insurance is there. Correct. This is one MCQ question which has come in the past and students make horrible mistakes here. Yes, because what will student think? Two things. He will either realize the fact that you can claim one of the two, and in that case he will start playing smart, saying, Rahul, let's do whichever is better. So let's do 40,000 rupees. No. People, if you have insurance, answer is only insurance. You cannot claim anything more than insurance. Insurance is the only number you can claim. The expenses is a condition given to only those persons who are not having insurance. So you have to be extremely careful on that adjustment of. Yes, be very, very smart and very, very careful on this adjustment of. It's important for you to keep in mind. Clear? Perfect. Chalo, let's move on, people. Last few things to be discussed of. We are in adjustment number 44. Adjustment number 44 is one of the past exam questions where students made some mistakes. So look in carefully. It says donations which are made by an individual to Gurudwara for 70,000 rupees in cash. The item is debited to P&L account. This is the first problem area. This is the first problem area. People, if you understand this carefully, anyone who's making a donation, first of all, it is not incurred for business reasons. When donation is not incurred for business reason, it should not be part of P&L itself. The first thing which I'm going to do is, I'm going to disallow under PGBP. First things I'm going to do is I'm going to disallow it under PGBP because I should not have made a payment in P&L. I cannot have a donation made in P&L. It's not incurred for business purpose. Now that I'm moving for donation to ATG, ATG will now have a problem because ATG comes and says, my dear child, when you're paying a money to Gurudwara, which is category D, you can claim 50%. Had you made the payment not in cash, if you make a payment more than 2,000 in cash, that donation is ignored off. Yes, so you cannot claim a deduction under ATG as paid in cash. Yes, so always realize the fact that when you see the adjustment saying it is debited to P&L, it is not just your ATG which is impactful, it is also your PGBP which is impacted. So please make sure that you first impact PGBP before you take it forward to ATG conditions. Clear? Very good. Next one says, people, political party payment is 10,000 rupees and advertisement and publication to political party is 15,000. Now look very carefully. In point number A, I very explicitly gave that this is debited to P&L. Whereas in point B, I have never given such conditions. When it is not given, don't make assumptions that it is there in PGBP, which is not to be made unless the question clarifies it. If the question comes and says it is there in the P&L, if a question says it in the table of P&L itself, then it makes sense. But if you see something like this in additional information, don't make such assumptions, which means I am not going to make an assumption that there is anything to be done in PGBP. I'm simply going to claim deduction. Now, what is the deduction? People, income tax comes and says, when you make a payment to political party, allowed perfectly if not paid in cash. So I'm going to say, allow 10K if not paid in cash. Allow 10K if not paid in cash. However, the problem comes on the 15,000 rupees. Notice it says 15,000 is for advertisement and publication by political parties. And that's where the problem comes, because section 80 GGC. Section 80 GGC comes and says advertisement in political party is a condition which is only given to companies. It's a condition only given to companies. And here the question comes and says this is an individual. Yes, when it is an individual, I cannot claim the deduction. So I'm going to say ignore the 15K. Ignore the 15K as only allowed to companies. Ignore the 15K as only allowed to companies, and that's what the conditions are. I hope you understand the conditions properly, people. That's the most critical thing to be kept in mind. Yes, to be extremely careful when it comes to these kind of adjustments. Be very smart on how you do it. Political parties have been coming in exam almost very often, and you have to be careful on the fact that when it's political party that you give donation to, even individual can claim, and that's what you're going to get in compulsory question. But if you see any kind of advertisement in political party, ignore that adjustment and say you cannot claim it as deduction because it is only for companies and not for individuals. So you have to ignore that adjustment off. That is the critical part to be kept in mind. Are we clear? Yes, perfect. Let's move on forward, people. I'm at the last 5 things. We are at 45. 45 says interest income rules under IFOS and chapter 6A. They want to know what is the interest income rules under IFOS and chapter 6A. They want a summary of it. Let me give you the summary. First, let's talk about what kind of interest income can you earn from. I can earn interest income from post office savings, correct? So I can earn income from post office savings. I can earn income from normal savings. I can earn income from FD. I can also earn income from RT. Correct? Not correct? Okay, so these are the 4 places where I can get interest from. At this stage, I will ask a very simple question. What are the conditions under IFOS? Is there any conditions under IFOS? Answer is yes. In post office savings, people, I have an exemption of 3,500 per annum. If you remember this, income tax comes and says any post office savings will get an exemption of 3,500 rupees per annum under IFOS chapter itself. For the balance things, the answer is fairly simple. Nothing is given. It is fully taxable. It is fully taxable. Then comes the question on chapter 6A. Now, is there any conditions under chapter 6A? Very obviously, what are the conditions under chapter 6A, people? Chapter 6A comes and says that when you have any post office savings and normal savings, then this person can claim a deduction of maximum 10,000 rupees under post office savings and normal savings. Under post office savings and normal savings. Nothing to be given here. Nothing to be given here, but you can claim a maximum of 50,000 rupees for a resident senior citizen under any deposit. You can claim a maximum of 50,000 rupees as a resident senior citizen under any deposit. Matlab, a resident senior citizen, whether he gets money from post office, whether he gets money from anything else, it does not matter. And therefore, he will get a deduction no matter what. Let me put it better way, people. I can say here maximum 10,000 rupees for normal citizen. Yes, so it's going to be maximum 10,000 rupees for normal citizen, and this is what the provisions will look like. So this is how I'll answer the question. No deductions which will be given for FTs and RDs. FTs and RDs have nothing to do with this. This is how the conversation will, this is how you have to look at the understanding of. Yes, so here it will be no benefits given to you whatsoever. And that is how the answer looks like. So if you remember this properly, people, then you can save a lot of time in understanding what IFOS and your chapter 6A deduction look like. So be very, very careful on this adjustment of. Yes, so provisions are fairly simple. If you are going to have post office savings, 3,500 exemption under IFOS, then you can claim a deduction of 10,000 if you're a normal citizen and 50,000 if you're a senior citizen. If you have a savings account is anyway taxable, but you can claim 10,000 for normal citizen and 50,000 for senior citizen. FD is anyway taxable, no 10,000 rupees ka deduction for normal citizen, but you can claim 50,000 for senior citizen. And RD works on the same logic, and therefore that's how the answer will look like. I hope you understood this logic, people. Clear? Yes, perfect. With that understanding, people, I'm moving on to the last few things. The thing which I'm going to have, the amendment of current year. The reason I put this off is because this is the important one, amendment. Expect an MCQ question from this. So be very, very careful. The question comes and says, I have a return of income of 21-22 filed with belated on 10th August 21. Yes, so I filed a belated return on 10th August 21 with a tax liability of rupees 7 lakhs. So I have already filed a return on tax liability of 7 lakh rupees. 7 lakh rupees offered on 10th August 2021 from my side. Now he wishes to file an updated return. I wish to file an updated return on 12th December 2025. 12th December 2025 is when I want to file an updated return by reporting a tax liability of 9 lakh rupees. I want to change my tax liability from 7 lakhs to 9 lakhs. Can I do it? Answer is yes. Answer is yes. Income tax says if you have an updated return, you can update the return if it is increasing the income. So yes, you are permitted to file an updated return, but when you file an updated return, you have to pay additional tax of, people, now you have to ask yourself, when am I filing the return? Look very carefully. It says my return filing due date, generally the updated return says you can file updated return within 4 years from the end of the assessment year, which means my assessment year is 10th August 21 and I have to file within 4 years. So 10th August 21 se pehle complete the year, which is 31st March 22. 31st March 22 se 4 years becomes 31st March 2026 tak. Yes, so 23, 24, 25, 26. So that time I have time. Now I am in 12th December 2025, which means I have to check which year I am in first of all. Yes, so look very carefully. I am telling you my filing due date is 10th August 21. Yes, if my filing due date is 10th August 21, I first completed my year, which is 31st March 2022. Now from 31st March 2022, income tax says if you file the return anywhere before 31st March 2023, I would ask you to pay a tax of 25%. If you file the return anywhere before 31st March 24, I'm going to ask you to pay 50%. If you're going to pay anywhere during 31st March 25, I'm going to ask you 60%. And if you're going to file the return anywhere before 31st March 26, I'm going to ask you 70%. That is what the rules are. Yes. So with that rules, people, you're going to figure out the answer. What is going to happen? I'm going to say 22 ke baad 23 he filed. No. 24 he filed? No. 31st March 25 did he file? No. He filed it on 31st March 26 ke pehle. He filed somewhere in this period. Yes, when he's filed somewhere in this period, which means the tax payable by him is going to become 70%. So he has to pay additional tax of 70% of the 2 lakh rupees. He has to pay an additional tax of 70% on 2 lakh rupees. That's the amendment of current year. Yes, next one says, I want to report a tax liability of 5 lakhs. People, I was already at 7. Can I report a tax liability of 5 lakhs? No. Income tax has made it extremely clear that when it comes to updated return, in updated return, you cannot file a tax payable lower than what you showed in the return, which means it should be only filed for department benefits. If you are going to go from 7 to 5, you are expecting a refund, department will not give it to you. So here you are not allowed. You are not allowed to file an updated return, and that's how the conversation is. Clear on the conversation, my friends? Yes, perfect. Let's move on forward to the last 3 things for us to complete this off. It says general adjustments. What if the question says the return is filed late and no regime is mentioned? Yes, normally people, I've always told this in the class, that when a regime is not mentioned in the question, the understanding is you have to do both the regimes. But here is a twist. Notice the twist carefully. It says if the return is filed late, when the question says the return is filed late, there is one thing that you have to keep in mind. Default tax regime by name itself suggests that when a person starts the year, he will be in DTR. However, if he wants to choose ATR, he needs to file a form and he needs to confirm it minus due of return filing, which means when he files a return, he needs to file a form along with it and confirm that I would like to choose ATR. Now, here is a case where the person has not even filed a return on time. When he did not file a return on time, on 31st July or 31st October, he did not file a return. When he did not file a return, it is obvious that he would have not filed a form itself. When he did not file a form, income tax would have made an assumption at that point of time that you will not be choosing ATR, but you will rather choose DTR. Yes, the rule is very simple. You need to file your forms before the due date of return filing. If you don't file your form before the due date of return filing, it is assumed that you want to go for DTR. You will not be allowed for ATR, which means in this case, the answer is DTR only. Yes, so despite the fact that no regime is mentioned, the understanding should be very simple that the person will have to choose DTR because no other choice will be left with him. His mistake to not file the return on time. Clear? Yes. Good. Adjustment number 2, people. It says winnings of 70,000 rupees net is credited to P&L account. When it says net is credited to P&L account, first things you need to figure out that the P&L has a credit. Matlab, I have a P&L credit of 70,000 rupees. First, that is an error because my P&L is only for my PGBP incomes. Showing winnings of 70,000 rupees means that I am trying to report it as PGBP, which is wrong. A winnings is always an IFOS income. So the first thing which you need to do is remove it from your PGBP statement. So first things you'll do is, Rahul, how much is there in my P&L? My P&L has 70,000 rupees. So first, remove 70,000 rupees. The first thing you need to do is, people, you need to reduce 70,000 rupees while calculating PGBP. You have to reduce 70,000 rupees while calculating PGBP because in my P&L the number is 70,000, which is wrong. I should not have a 70,000 number. That is an IFOS number. Next comes the problem. People, now that this number has to be moved to IFOS, can you move 70,000 to IFOS? Answer is no. Notice the line very carefully. It says this is net. Net matlab the payment which is showing in the P&L is actually after TDS. And winnings, you know, has a TDS of 30%. So when the winnings is 30%, the one understanding is very clear. A person cannot tax his net number. He has to tax his gross number. So which means I will come and say, had TDS not happened, how much income I would have got? And that's very simple. If 70,000 is 70%, number should be 1 lakh rupees. And therefore, in this conversation, I will say tax 1 lakh rupees under IFOS. Tax 1 lakh rupees under IFOS. Now, there is only one silly mistake which students end up making, that they get confused. They come and say, Rahul, when I've reduced 70,000 from PGBP, why am I taxing 1 lakh rupees in IFOS? Why should it not be 70 there? Or if I'm taxing 1 lakh rupees in IFOS, why am I reducing 1 lakh rupees? Why am I not reducing 1 lakh rupees in PGBP? The understanding is fairly simple. The mistake is there in the PGBP itself. If you notice the PGBP, my income itself was 1 lakh rupee. From the very start, I was eligible for an winnings of 1 lakh rupee. But you reporting 70,000 rupees in PGBP itself was a mistake. So you cannot be coming and talking about what you have done wrong. You should basically rectify the error as it is. So I will come and say the mistake is of showing 70,000 rupees. That is the number by which your P&L is tainted. It is not the 1 lakh rupees which is in the P&L. It's the 70,000 rupees which is there in the P&L. So I will only reduce 70,000. Then I will come to IFOS and come and say the tainted element has to be corrected. Let's correct it and make it 1 lakh rupees. So be very careful on two different numbers, but the answer remains the same. So be very, very careful on how you read the question off. Clear? Perfect. That leaves me with the last two people. The last two questions basically come and say, what happens if you have salary, rent and HP and the word used is received? If you see a question in exam and the question in exam says salary received, rent received, then that means that this is the number which I have in my hand. And why am I telling you this? Because if you see the question and the question says salary received is 7 lakh rupees, it means this salary is the actual basic salary. And when you know this is the basic salary, the chapter of salaries come and say you need to grant the standard deduction. Yes or no? Similarly, people, when you see the question and the question says rent received is 5 lakh rupees, it means that is my GAV. You have never reduced your 30% on it. So you have to reduce the standard deductions. You have to reduce the standard deductions. Correct, not correct? Be very, very careful on this. This is something which will always come in every examination. I say I will love to confuse you with English, so be very smart on it. Second word says, what if the word used is computed? Computed word itself means that salary is already confirmed to you, this is a number. Rent already is confirmed to you, this is a number, which means this is after standard deduction. This is after standard deduction, no adjustment to be made. This is after standard deduction and no adjustment should be made. Be very, very careful on this adjustment of, my friends. Any doubts on this part? Yes, yes, this is what the question is. So be extremely, extremely careful. Clear? Yes. Perfect. With this, people, I'm done with the last adjustment. The last is a fun question which I've prepared from my side. One of the trickiest questions which I've seen, and I've prepared it from my end so that you can also get confused. There are multiple elements which are going to get tested here. So look at the question very, very carefully. Let's see if you've got the right answer. I hope you have done this question before you're checking with me. If you have not, please pause, complete this question and then check this answer with me, because you're going to have a fun time understanding what kind of intricacies this question has. First, people, question says you're required to compute the tax of ATR under section as the age 61 years with the resident person. With the following incomes being granted to you. Question says I have a PGBP income of 7 lakh rupees. I have a 112A income of 5 lakh 70. I have 112 loss of 2 lakh rupees. I have PGBP loss of 2 lakh 60, and then I have a chapter 6 reduction of 5 lakh rupees. With this is the question. They are coming and asking me compute the tax under ATR scheme. ATR scheme has been requested for you. At this stage, always follow the master rules. Always first figure out what is happening. First things, I need to know my total income. Now, to know total income, there are some adjustments which I have to make. And that's where you have to figure out things first. I have chapter 6A also. I have losses also. What takes place first is the question. And the answer is fairly simple. It's always in the same sequence. First happens losses. So first, what I have to do is I have to now set off my loss first. So let's set off losses. I have two losses. One is LTCG, one is PGBP. Tell me which should happen what. Very simple. Always intra-head rules apply. So intra-head rules will apply first, which means I will first set off 7 lakhs against 2 lakhs. Hey, see, I will set off 7 lakhs against 2 lakh 60. Correct? Yes, PGBP to PGBP, no people. Yes. Next, I am going to be looking at LTCG to LTCG, which means this is the next loss which I'm going to set off. These are the two losses which I have to set off, and that's how my answer will come to me. Agreed, not agreed? Yes. So which means I now have a computation number. My 7 lakhs is getting set off against 2 lakh 60, giving me an answer of 4 lakh 40,000. Giving me an answer of 4 lakh 40,000. Adjustment here will become 3 lakh 70,000. Adjustment here will become 3 lakh 70,000. This has gone, this has gone. Left of chapter 6 a reduction of 5 lakh rupees. Left of chapter 6 a reduction of 5 lakh rupees, and that's what the answer is. Clear with me, my friends? Any doubts on this part? Very good. With this understanding, people, the next thing and the most critical thing for you to do, and this is where you're going to make some mistakes, so look very, very carefully. What is going to happen? I am now going to come and say there is a chapter 6 a reduction. And logically at this stage, what most of the students will do is they'll take 4 lakh 40, 3 lakh 70, which is 8 lakh 10,000. And they'll do 8 lakh 10,000 minus 5 lakh rupees. They'll say it is 3 lakh 10,000. 0 marks. Absolutely 0 marks, because notice and remember this one thing carefully. Income tax clarifies chapter 6 a deduction can only be claimed against slab incomes. I cannot claim Chapter 6A reductions on any special incomes, including capital gains. Even capital gains are not eligible for Chapter 6A reductions, which means Chapter 6A reductions has to be restricted to your slab incomes. That is the only thing which is eligible for tax liability. Yes, which means at this stage, what is going to happen is I'm going to take this number and I'm going to set it off only against this. I cannot set off anything else. I cannot set off anything else. It has to go against that only, which means this is how the computation will look like, giving me a PGBP number of 0 right now. Giving me a PGBP number of 0 right now, and my 112A income is going to become 3,70,000. My 112A income is going to become 3,70,000. This is my answer, people. This is how my statement looks like. This is how my income is going to be computed to me. Agreed, not agreed, yes or no? This is how the answer is. Any doubts on this part? Clear? So be very careful, people. Multiple things have taken place. First, I've done set off of losses. One set off of losses, I've done Chapter 6A reduction. Chapter 6A reduction only against slab income has taken place. I will not have a Chapter 6A reduction under capital gains. Cannot do Chapter 6A against capital gains. Not allowed at all. Yes, so I'm going to rather put it here, only against slab. Irritating. Once again, yes, so I'm going to say only against slab. Correct? Yes, very good. At this stage, people, I now have an income. My income is PGBP is 0. My 112 is 3,70,000. My total income has come to 3,70,000. This is my total income, first of all. Step number 1. At this stage, my step number 1 is completed. I've completed my total income to be 1 lakh. And then comes step number 2. Step number 2 is the very important step to first figure out, are you rich, poor, middle class? And I have confirmed to myself, ATR matlab this guy is middle class. This guy is going to be a poor category person, which means he is eligible for rebate. He is eligible for rebate. Yes or no? Yes. With my total income being less than 5 lakhs, I am eligible for rebate. But here is where you ended up making a horrible mistake. Now, at this stage, if you come and told me, Rahul, what are you talking? Rebate is not eligible on 112A income. Why are you giving him rebate and all? 112A cannot be claimed. People, before even you jump to rebate, there is one thing which you extremely missed out. And this is something which I started with this. When I started Super 50, I told you this and you missed it out still. The fact that now that you have incomes, I have to first come and do a very important step. The very important step is to first figure out which is my slab incomes and which is my special incomes. I have a slab income here. I have a special income here. Yes, when there is a slab income and special income, a rule of basic exemption limit kicks in, which means now Kaju Katli benefits are kicking in, where I will come and say, my dear child, I have not utilized my slab at all. My slab is literally showing 0. I have 0 money in my slab, which means I need to utilize my capital gains against it, and therefore I will offset number. Yes, so the step number 2 here is to offset number into my 112 and slab incomes. At this stage, I'm going to say nothing can be done. Kaju Katli effect. Yes, I'm going to put Kaju Katli effect. Basically, I'm going to say, I'm going to set off my slab incomes into my, I'm going to set off my special income into slab income because capital gain has to be utilized. But I only have to do it to the extent of my basic exemption limit. And this is where the answer will change. Look, my age is 61 years. With my age being 61 years, my slab is going to be what? My slab is going to be 3 lakh rupees. So I am going to do a Kaju Katli effect of 3 lakh rupees, and that means 3 lakh rupees is moving into slab right now. At that understanding, I will now come and say slab will now become 3 lakh rupees and 112A is only left with 70,000 rupees. 112A is only left with 70,000 rupees, and here your answer changed because at this stage what happened, I simply came and said, my dear child, the moment you said 3 lakh and 70,000, 3 lakh pe tax liability is 0 because basic exemption limit is nil. 70,000 pe also the tax is 0. No, 70,000 pay also the tax is 0 because at the end of the day 112A says you will get an basic exemption of 1,25,000 there itself. Yes, so you will say tax is nil as it is within 1.25 lakhs. Tax is nil as it is within 1.25 lakhs, which means overall my tax is equal to 0. My tax is equal to 0. That's the question, people. Yes, a very beautiful question where you have to figure out what is happening. Notice multiple things happening here. First thing is I had to set off my loss. Second thing is I had to set off my Chapter 6A. Third thing is to remember the Kaju Katli effect, and that's when you will be able to figure out the fact that your tax liability is actually 0. Yes, now just to complicate this a little better so that you understand this better, if I come and tell you what if the age was, let's say, 45 years. Just to add in an additional concept, people, just to add in an additional concept, what if the age is 45 years? At this stage, what will happen? Now, what will happen, people? I will take the numbers from here only, because nothing is going to change from here. Till here, everything remains the same. So I'm going to copy paste the whole thing, and I'm going to put it down, and I'm going to say, if the person's age is 45 years, if the person's age is 45 years, my Kaju Katli effect is not going to be for 3 lakh rupees, because the age itself is 45 years. My slab income becomes 2 lakh 50. Yes. So with my slab income becoming 2 lakh 50,000, my slab income moves down to 2 lakh 50,000. Correct. With my slab income being 2 lakh 50,000, my slab left off is 1 lakh 20, I guess. Yeah. Yes, so I have 1 lakh 20,000 rupees, which again means the same thing, because at the end of the day, my slab income, I am having an exemption of 1 lakh 25,000 rupees, and therefore nothing is going to change in the question no matter what. So even if I look at this, I think I have done this properly. Let me just check very, very quickly. Yes, I think everything looks fine. So I have nothing else to do in this, which means at 3 lakh 70, nothing is going to change. 1 lakh 20 will come in, which means against the tax will be 1 lakh 25,000, and that's how the answer will be, which means tax at the end of the day is always going to show 0, not for the reason that you had enough losses and all, not for the reason of anything else, only for one reason, because your Kaju Katli came to your rescue. Be very, very careful. Clear? Yes. Now the one thing which you probably have to keep in mind, people, is that in this question, if at all 112A was not 3 lakh 70, but probably let's say it was 4 lakh 50 and all, then in that case, whatever tax would have come in the second scenario, whatever tax would have come at that stage, you would have come and said, because the tax is there, you cannot claim rebate under 112A, because at the end of the day, 112A rebate is not eligible under ATR. You cannot claim rebate on 112A. You could have claimed against anything else, but you don't have that income. So therefore, 112A rebate will not be given to you. You will restrict yourself there, and that's how the answer will look like. Clear? Yes, that is what the question was designed, people. That is how the question was prepared, so that you understand what is happening. And that's your Super 50 adjustments. We have spent 3 hours doing the Super 50 adjustments only for one reason, because I tried to accumulate every single possible difficult questions for you to prepare properly and for you to be prepared extremely well for your examinations. I hope this video was really helpful for you to figure out what mistakes you have been making and why DT seems a little difficult when you don't pay the proper attention to it. So yes, if this video has been any helpful to you, please drop a thumbs up and let me know what is happening in this video. If there's any other recommendations you have, any other suggestions you have, anything else that you would like to learn from me, please drop it in the comment section, and I'll be happy to report to all of you everything as soon as possible. Except for one thing, yes, the marathon is pending for a long time. I'm trying my best to get this off, but I thought these questions are more critical than the marathons, so I wanted to figure this out first. The marathons are also in due course, will be released to you, so please don't worry about it. But meantime, please do continue with your preparations and finish it as smooth as possible. Yes, I'm still waiting on your comment section, people. So please go and fill the comment section by letting me know how many adjustments you got right and how many marks have you scored out of the whole adjustment sheet. If you have done anything more than 30, 35, you're going to be amazingly well in your examinations. If you've got anything less than 35, trust me, people, I'm extremely proud of you as well, because at the end of the day, with this video, I'm sure you have now understood everything else and you are ready for your examinations to tackle the toughest to the toughest questions of. Yes, with that positive thought, I would like to end this video for today. Thank you so much for sticking with me for 3 hours and getting this done very beautifully along with me. I hope you have a wonderful, wonderful time ahead preparing for your examinations and doing extremely well, because I know May, September and Jan, final attempts for you. Last pull you have to do, because yes, after next May, you have new income tax 25 coming in, and I would like every single one of you getting through this examinations in beautiful flying colors and becoming a CA finalist as quick as possible. Take care, everyone. Have a wonderful learning ahead. See you. Bye bye.